Good morning, everyone, and welcome to the May 14th meeting of the FASB's Public Markets Advisory Committee. I'm Alicia Manders, an Assistant Director at the FASB, and I'll be chairing today's meeting. It's just wonderful to see you all around the table. Today, we're very pleased to have the PMAC members that have joined us around the table in person. We also have a number of members that are joining remotely from various locations, and FASB project team members who will be joining us throughout the sessions today. The names and affiliations of PMAC members are available on the FASB website, but I do just want to mention a few people who are joining us for the first time. So we had five newly appointed committee members that bring a variety of experience. So joining us virtually, we have Brad Brobick, Peter Konbrick. Joining us in person, we have Mary Hill. Joining us remotely, we have Niall O'Malley, and in person, Abhay Shrivas. I'm going to work on your last name, but Abhay, it's wonderful to have you here. Also, we have Kathy Shakespeare, who is an incoming FASB board member. She'll begin her official term on July 1st. So if you haven't had a chance to meet her, please introduce yourselves during the break. Given the mixed format of the meeting, I've asked Janice to help me with the queue and keep track of the discussion when it gets more active. And for those that are joining via Zoom, please use your raise the hand feature on Zoom and we'll get you into the queue. Also, just as a reminder, if you can please keep your audio on mute when you're not speaking. For those that are here in the room, we just want to turn your name card on its end when you'd like to join the queue, and we'll call on you. For the mics, you just push the green button in the middle here to talk, and then please just remember to turn it off. Otherwise, the video will stay on you as well. If you have a comment that's directly on point that you want to make, and you see a lot of people waiting, and you think it would be better to jump in, just give us the double hand signal, and we'll get you into the queue earlier. So with that, let's just briefly go around the table for introductions. And then, as you can see from the agenda, we've got a lot to cover today. So, Nellie?
Good morning. Nellie Dubler, FASB Deputy Director.
Jennifer Weiss, FASB Senior Staff.
Katrina Popel, FASB Staff.
Edward Garcia, Practice Fellow, FASB Staff.
Erica Friend, FASB Assistant Director.
Penny Pepperling, BDO.
Abhay Shrivastava, Managing Member, AS Investment Partners.
Fred Cannon, FASB Member.
Randy Oberdick, Forvis Mazars.
Sue Cosper, FASB.
Bob Rook, Managing Director at Alvarez and Marcel.
Marcia Hunt, FASB.
Jeff Ford, Fastly.
Hillary Salo, FASB Vice Chair.
Jason Guys, KPMG.
Rich Jones, FASB Chair.
Rosemary Sangiulo, FASB Deputy Director.
Kathy Shakespeare, FASB.
Heather Jossam, PCOB, Office of the Chief Auditor.
Richard Forrestel, Cold Spring Construction in Akron, New York. Kathy, please tell me you are either in Ann Arbor or Indianapolis when Michigan won, please.
Yes.
Joyce Joseph, FASB Member.
Jared Goodman, Colorado Para.
Marcel Snijman, Graham Holdings Company.
Mary Hill, Professor, Kennesaw State University.
Christine Bodison, FASB Member.
Greg Wayna, Interim CFO, Large Cap Multi-Industry Companies.
Hi, I'm Jack Dade, Director, FASB Staff.
Trey Sinkfield, FASB Postgraduate Technical Assistant.
Janice Jang, FASB Postgraduate Technical Assistant.
Terrific. And online, Brad?
Good morning, Brad Broberg from RSM.
Peter?
Peter Combring from CBIZ CPAs.
Mark?
Mark Hamill from Assay Research. I cover software companies.
Niall?
Niall O'Malley with Blue Point Investment Management.
And Michelle?
Hi, everyone. Michelle Reynolds, Chief Accounting Officer at Reddit.
Terrific. Great. So with that, as you can see from the agenda, we have a lot to cover today, and we're very interested in hearing your views and input on quite a lot of topics. Most of today's sessions are on a variety of the FASB's technical projects in which the board has reached decisions, and we'll go through those decisions before the board seeks public comments on those projects, or their research projects that the board will be considering whether to add a project to improve those areas. And this afternoon, we'll finish off our discussions with a session about technology and also have some time reserved at the end of the meeting to ask PMAC members for their feedback on other areas that you'd like to raise potentially for future meetings. So before we get into the first topic, I just want to mention that we did have 2 PMAC members that completed their service this spring. We had Tony Aponte, who is heavily engaged in starting his own new firm, and Penny Pepperling, who will be retiring in August and is attending today as her last meeting. So Penny, just want to thank you for all that you've provided to the group over the years. It's always been amazing how you've brought in such great perspectives, diverse perspectives, and also the experience that you had with so many different private company clients. So just really appreciate your service on this group, your dedication on all of the topics that we've covered over the years. As a small token, we will be mailing you a small gift, but just want to thank you on your retirement and our appreciation for participating. We'll also be looking to add some additional new PMAC members at the beginning of 2027, as we do with our annual rotation. So if you have others that you're either colleagues or folks in your network that you think would be good additions, we're always open to those ideas, and please feel free to let me know if you have any. So with that, let's go ahead and get into the first topic on the FASB update. And I'll turn over to Nellie.
Great, thank you. We have 4 topics that we want to just kind of briefly give you an update on. We're happy to answer questions, chat about these more, but mostly this is just kind of an FYI. So the first one to cover is the agenda consultation. This is an important part of foreshadowing because you're going to hear this come up a lot during the day today. Many of the topics that we're discussing with you relate to feedback that we received in our agenda consultation initiative over the last year. So starting at the beginning, in 2024, the board was making good progress on the topics that were on the agenda, so decided to undertake another agenda consultation initiative. And as part of that process, we started with the FASB staff reaching out to over 200 stakeholders to ask them a very simple question: what do you think the board should be working on? So we took all of that input and combined it into an invitation to comment, or ITC. An ITC is a staff document. It doesn't include board views. The board doesn't vote on its issuance. It's essentially just a list of questions, and the agenda consultation ITC had 42 different technical topics and 50 questions for respondents. So that was issued in public comment in January 2025, and then comments were due in June of 2026. Maybe I have that backwards. June of 2025. Yes. Okay. Thank you. Perhaps we should have anticipated this, but we got a tremendous amount of input in response to that ITC. We got responses from about 120 stakeholders, and they were very thorough, detailed responses to all the topics and questions that we had posed there. And we really appreciate the amount of time and effort that our stakeholders put into responding to this document. So once we got that feedback, the board met in October of last year to kind of begin the process of working through that feedback. And now we're in the process of bringing back every topic that was raised by comment letter respondents, bring those back to the board individually so that the board can decide whether to add a project in those areas, whether to kind of continue to work on that or something else. So that brings me to this color-coded slide and its fellow, which is next, but we'll talk about this one first. This is through the end of April, and this covers what the board has talked about so far. So we've got some things have been already added to the board's technical agenda. Some things the board asked for kind of more research or a little bit more detail before making a decision about the technical agenda. And then we do have a set of topics that the board has decided not to pursue further at this time. We've got that list on our next slide here. So we're continuing to work through all of this. We think this will take us through, at least the end of the summer to get back through the rest of these topics. Just yesterday, after these slides had been distributed to you all, we considered a couple more ITC topics and added 3 more projects to the board added 3 more projects to their technical agenda. So this work is kind of continuing as we move through this. And as I mentioned, you'll get a chance to talk through all the various projects that are resulting from this feedback. Many of the things on our agenda, again, relate to this. And we also welcome any feedback you have about the process or questions about the decisions the board has made so far. So that's the agenda consultation. If there's any questions on that, I'm happy to chat about them. And if not, I have 3 more quick updates on other types of things. Anything there? Yeah.
From from an investor perspective, I would just recommend the amortization topic to go from yellow to green. I think it's one of the most commonly adjusted factors from investors, which to me signals that there's a gap between the way investors look at things and how GAAP looks at them. So that's something I think should be on the agenda.
Great. And are you thinking of the goodwill topic, amortization?
Can you go back? It was amortization. Oh, sorry.
No.
Yeah, the intangibles.
Intangibles. Yeah. Okay. Great. That's really helpful feedback where we've got a lot to work through in those areas. Anything else on the agenda consultation? Okay. So the next project I'd like to provide an update on is our EITF issue related to paid in kind or PIK dividends. This was final guidance that was issued in April. I think we may have given you a brief update on this, but it's been a while, so I just want to kind of refresh that this has been issued. So this was an agenda request received by the EITF in late 2024, and it related to the initial measurement of paid in kind dividends on equity classified preferred stock. So this is situations where an entity would pay a dividend on preferred stock in additional shares of that investment. That could be by increasing the liquidation preference of that preferred stock or something else. The EITF recommended measuring PIK dividends on the basis of the PIK dividend rate stated in the agreement. So the agreement might say PIK dividends are calculated by multiplying this PIK dividend rate by the liquidation preference, which is the amount of the value of the shares, sort of. So that would calculate the PIK dividend, and that's the amount that the EITF decided to recommend that be used for the initial measurement of those dividends. There had been some diversity in practice. The EITF considered, for example, whether that should be measured at fair value and decided to go with the PIK dividend rate. In our current EITF structure, the EITF provides a recommendation to the board, and then the board decides whether to add that to their agenda and moves through their kind of standard due process. So the board did that, added that to its agenda, and this was issued for exposure for public comment in September of 2025. And as I mentioned, the final guidance was issued in this topic last month. This guidance applies to all entities. In this case, the final guidance is really only specifying the initial measurement of these paid in kind dividends. So it's not addressing subsequent measurement. It's not addressing disclosures other than kind of transition disclosures. We hope that this is a helpful clarification. That this is an area where the board can reduce diversity in practice in a straightforward way. We'd be curious if you've seen these investments, if you have these, if this is something you think could be affecting you. But we're looking forward to seeing this being applied in practice. So that's PIK dividends. If there's no questions or comments on that one, my next quick update. Oh, yep. Okay.
Yeah, so I'm not very privy to this topic, but I know preferred dividends anyway don't have, there's not a legal responsibility for the board to pay the preferred dividends. So companies have the choice to disallow it. So on the top of that, if you are having a PIK, it basically means, from my perspective, if I am a preferred stockholder of a company, I'm not going to get paid, basically. Period. Right. So I have seen situations where the companies whose revenue has been declining just because of whatever market conditions, and they disallow dividends. Now, allowing PIK on the top of that on a security which does not has a legal claim anyway, or not has a higher legal claim, in effect basically means that I'm not going to get. I'm just trying to understand that what is the purpose behind even valuing them and showing them in the financial statements when, from an investor perspective, there's a very high chance that I'm not going to get paid. So maybe I don't know the context behind it from where it is coming on, but I'm just trying to understand, because the situation like this recently happened in the past 1 year on a security that I was holding. So I'm trying to understand what's the purpose behind it, of showing this valuation.
We'd be happy to talk through this in more detail if you've got a specific situation that you're talking about. But if I think about the preferred stock has a liquidation preference, which is sort of like the value of it, and the paid in kind dividend is increasing that, which could affect the amount like that investor eventually would receive in a liquidation and some other type of thing. The value of that investor's holding is being changed, so they're not getting a cash dividend in this case, but the measurement does reflect that. So that was one of the things that EITF considered. The EITF did think about whether to have different measurement based on whether the paid in kind provision was discretionary or something else, and ended up thinking that this would provide the best information about what was happening there. I don't know if anyone else wants to weigh in or other.
I mean, I think the focus of this was a very narrow practice application issue with regards to the measurement of PIK dividends. So I completely understand your point from an economic perspective of, do I think I'm going to actually get that, value, right, if from the entity, if it is in a PIK dividend form. But I think the question was really, when a PIK dividend is issued, what should it be measured at, right? There was some diversity in practice out there of whether folks were using like the liquidation preference or the terms that were in the actual, preferred agreement, or whether they were using fair value, for example. So I think this was really just a situation where we were looking to reduce diversity in practice and provide specific measurement guidance in that circumstance. But completely understand the concerns from a broader standpoint about your preference or not preference, right, from a PIK dividend rate. Understand that.
Thanks for clarifying. It's just for measurement of the PIK, but it's not going to be shown on the a balance sheet as a liability.
Sorry, what? Yeah. Yeah, it depends on the timing of it, but it's just the measurement of when it's recorded. What is it recorded at?
Thanks for clarifying.
Yep.
Great. My next quick update is another EITF project related to market return cash balance plans. Market return cash balance plans are a type of pension plan and specifically a type of cash balance plan, and they are currently accounted for as defined benefit plans. I don't think we've talked about this extensively with PMAC, so again, just wanting to give you a quick update. This was something the EITF met to discuss last year in September. And again, the EITF develops a recommendation for the board. So for these market return cash balance plans, if they meet certain criteria, the EITF recommended that the discount rate would be set equal to the assumed interest crediting rate for discounting the obligation. That discount rate is the main disconnect that had been observed in practice and a source of some concern about the accounting for these. In a low interest rate environment, that discount rate can result in a higher liability, and that was perceived as a negative in the accounting for these plans. So this change that's recommended by the EITF should help address this and make the accounting for these plans more representative of the economics of those. That EITF recommendation went to the board this winter. We expect to issue an exposure document on this topic in the coming weeks. So similarly to the PIK dividend EITF issue, we expect this to be kind of a narrow clarification for measuring these plans. We expect this will help clarify the guidance and be help useful in practice when thinking about the accounting for these plans. The research and outreach we had done on kind of the prevalence of these market return cash balance plans did indicate that they exist for some smaller companies, but we don't have a good sense of exactly how many entities have these today. There's some indication that maybe people haven't adopted this type of plan over time. So we'd be curious in the exposure period or otherwise if you have feedback on whether you've seen these or how common they are or other feedback related to that. Yeah, is there? Sure.
Just because we have cash balance plans, and that's one of the things that's been talked about is to have a better connection between the returns that you have in the cash balance plans and the reality, because we've sort of supplemented because we have an extremely overfunded pension plan, like 600-700% overfunded. And we've been doing a lot of things with our pension plan as much as possible to compensate employees that way and save sort of cash, that we would spend otherwise. So we've moved a lot of our matching and our 401k into our pension plan as a company, and they are exploring, because now people don't have the ability to invest that money the way they wanted to, like in a 401k plan, but it's still at the crediting rate, which it's been one of the negatives of the cash balance plan. You know, we've got some other benefits from that, but so I'm curious to sort of see what that looks like. And you know, you talk about the issues around the discount rate specifically, and we have one developed discount rate. We have a different interest crediting rate between our traditional pension payment modules within our plan and otherwise. But yeah, I'm definitely curious to see what.
Well, we have our exposure period coming up, and luckily you've added yourself to our list of people to talk to about this document to make sure we get your feedback. But yeah, thrilled to hear that it'll be meaningful potentially for the types of plans you're dealing with. So that'll be great. Last but not least, I wanted to briefly talk about our project on environmental credit programs, partially to note that we've discussed this project with PMAC in the past, but I think it's been a while. This was a proposed ASU that the board redeliberated kind of at the end of last summer, and the team is in the process of drafting the final update, and we expect that to be released in the coming weeks. So this project addresses both the accounting for environmental credits themselves and environmental credit obligations. And let me just briefly comment on what this project is not doing. This project is not addressing the accounting for carbon emissions or sustainability reporting or anything like that. That's beyond the scope of the FASB's mission, so not something that we would take up. But in this case, entities are entering into transactions to buy or sell these credits, and that's a financial reporting transaction. So there's accounting that needs to be done there for those financial reporting situations. So that's what this project is addressing, is the transactions that are happening related to these credits. As I mentioned, this was a proposed update in 2024, I think, and then redeliberated last year. At a high level, this guidance develops a model for the accounting for environmental credits, separating them into compliance, non-compliance, voluntary credits based on certain factors. There's a model for accounting for environmental credit obligations. Certain types of obligations are linked to the measurement of the related credits, and other portion of the obligations are not. So the board's gone through and kind of put together guidance for how to think about this holistically. A key change in the redeliberations process, the proposed update had fairly extensive disclosure requirements, and this was a source of a lot of comment letter feedback. So that was an area where the board made a number of changes in redeliberations to exclude a couple of disclosures that had been proposed, not to finalize a couple of those things. So that was one of the big changes there. We're looking forward to the final guidance in this area again in the coming weeks, and hope that it provides helpful clarity for entities that enter into these transactions. So that's it.
Thanks, Nellie. So with that, we'll go ahead and get into our first discussion topic on indexation on debt and equity. So I'll turn it over to Erica, Edward, and Katrina to lead us through.
Thanks, Alicia. And thanks for having us today, and good morning, everyone. During this portion of the session, we will provide a summary and update on the indexation debt and equity project that was added to the board's agenda on March 18th. We'll also provide an overview of the current indexation guidance in subtopic 81540, which covers how to account for equity-linked contracts and stakeholder feedback that we have received to date. Throughout the discussion, we will pause to hand it over to the committee for discussion. We would like to hear your feedback on the board's tentative decisions, as well as related topics that the board will discuss at a future board meeting. Next slide. So the current project on indexation was informed by feedback received through the 2025 agenda consultation process, as well as targeted outreach with stakeholders. Last year in May, our team did meet with PMAC to discuss the debt and equity guidance and gather feedback about challenges members encounter in applying the current guidance, and whether members would support changes to the guidance even if the changes would significantly change current financial reporting outcomes. At that time, PMAC members generally noted that there were liability classification outcomes that they do not agree with, largely due to non-substantive terms in the contracts driving accounting results. Some members noted that contract terms that drive some of the complexity are often accepted by entities because that may be their only way to secure financing. Further, most members agreed that private equity companies should not have to bear the cost of the guidance to arrive at accounting outcomes that are not consistent with how the items are treated by investors. Several members noted that liability classified items are reversed out to be treated as equity in investors' analyses. Therefore, they were not against more items being recorded in equity. On March 18th, 2026, based on the feedback received from stakeholders, the board added this project to its technical agenda, and the board is expected to continue its deliberations in the coming months. The focus of the project is on the indexation guidance in subtopic 81540, which is applied broadly across equity-linked instruments, including warrants, convertible instruments, and other contracts indexed to and settled in an entity's own stock. And on the next slide, I'll briefly summarize the current guidance in subtopic 81540. So the current guidance here is a two-step analysis. Step 1 requires entities to evaluate a contract's contingent exercise provisions, if any are included in the contract. A contract fails this step of the analysis and does not meet indexation if the contingent exercise provisions are based on an observable market other than the market for the issuer's stock, or an observable index other than by reference to the issuer's own operations. If a contract does not fail step 1, then an entity moves on to evaluate the contract in accordance with step 2. Step 2 requires entities to evaluate the settlement provisions of the contract. A contract is not precluded from meeting indexation if the contract is fixed for fixed, or if the contract only includes variables that are inputs to the fair value of a forward or option on equity shares. A contract is fixed for fixed if the settlement amount of the contract is equal to the difference between the fair value of a fixed number of the entity's equity shares and a fixed monetary amount, or a fixed amount of a debt instrument issued by an entity. For example, a contract would be fixed for fixed if the holder can purchase a fixed number of the issuer's shares, such as 100 shares, at a fixed price of $10 per share. If the settlement amount of the contract is not fixed, the settlement adjustments do not preclude indexation if the variable is an input to the fair value of a forward or option on equity shares. And there are several examples in current GAAP that illustrate whether a contract is indexed to an entity's own stock or not. Next slide. So we wanted to touch on what we heard during outreach with stakeholders that led to the addition of the indexation project to the board's agenda. First, outreach consistently indicated that the current indexation guidance can be difficult to apply and often leads to outcomes that are unintuitive relative to the economics of the instruments. Second, stakeholders emphasized that step 2 of the indexation guidance, which evaluates settlement provisions, was particularly challenging and should be prioritized for improvement. And third, we heard that introducing probability-based concepts would likely not reduce complexity and could introduce new judgment and diversity in practice. Last, stakeholders noted difficulty in distinguishing acceptable versus non-acceptable leverage features, particularly when settlement adjustments are tied to an entity's own operations or activities. Overall, stakeholders were interested in an indexation model that was less complex and would reduce inconsistent interpretation and application of the guidance. Next slide. That feedback led to the board adding the project on indexation to its technical agenda with the objectives that directly reflect the overall feedback received from stakeholders. And to accomplish those objectives, the key improvements that the board is hoping to achieve would include eliminating the complex fixed-for-fixed assessment in current guidance, specifying that settlement adjustments related to an entity's own operations, activities, or stock price do not preclude an instrument from being considered indexed, and addressing the concept of leverage factors, which has historically created diversity in practice related to indexation outcomes. Next slide. And so to achieve those key improvements and objectives set forth by the board decided to pursue an approach referred to as the acceptable variables approach. This approach would retain step 1 of the indexation guidance, and changes under this approach would be targeted to step 2 of the indexation guidance. Under the approach, an instrument would meet indexation if the only variables that could affect the settlement amount are related to the entity's stock price or several other acceptable variables, most of which are included in GAAP today, with the addition of an entity's own operations or activities. If the instrument settlement amount is affected by variables other than those related to the acceptable variables, the instrument would not be considered indexed to an entity's own stock. This approach would also aim to achieve the key improvements that we mentioned on the previous slide. And overall, the staff expects that these changes are likely to result in more instruments meeting indexation. However, those instruments would still have to pass equity classification criteria in Section 815-4025 in order to be classified as equity. Next slide. So next, we have a couple of examples that we would like to walk through that illustrate how the indexation guidance would be applied under the acceptable variables approach. The first example illustrates a contract for which the settlement amount varies based on a revenue target. This example is one that under current GAAP does not meet indexation, but it would meet indexation under the acceptable variables approach. In this example, Entity A issues warrants that permit the holder to buy 100 shares of common stock for $10 per share at any time over a 10-year term. However, the strike price is reduced by 50 cents after any year in which the entity does not achieve revenues of at least 100 million. The warrants do not contain an exercise contingency, so step 1 doesn't apply in this case, and we can proceed to step 2. And for the purposes of step 2, the only variables that can affect the settlement amount are related to the acceptable variables. For example, strike price and revenue, which is related to an entity's own operations or activities. As a result, the warrants are considered indexed to the entity's own stock. This outcome is different than the analysis under current guidance, where indexation would be precluded because the entity's revenue is not an input into the fixed for fixed option pricing model. Next slide. So this second example illustrates a situation where the settlement amount varies based on the price of a commodity. This example does not meet indexation under current GAAP or under the acceptable variables approach. In this example, Entity A issues warrants that permit the holder to buy 100 shares of common stock in exchange for 1 ounce of gold. However, the warrants only become exercisable after Entity A completes an initial public offering. The warrants in this case do contain an exercise contingency, so step 1 must be analyzed. And the exercise contingency, which is the IPO, is not an observable market or index, so the warrants are not precluded from meeting indexation under that step. So we can proceed to step 2 of the analysis. And when evaluating step 2, the entity determines that one of the variables that would affect the settlement amount is the price of 1 ounce of gold. The price of gold is not related to any of the variables specified under the acceptable variables approach, and therefore the contract does not meet indexation and is precluded from equity classification. For this example, this outcome is the same under current guidance because the price of gold is not an input to the fixed for fixed option pricing model. Next slide. And so now that we've provided a summary of the new approach that the board has decided on for indexation, we have some questions that we would like to discuss with the group. First, do you have any questions or feedback about the decisions made by the board during its March 18th, 2026 meeting, including any questions about the acceptable variables approach? Second, do you think the acceptable variables are well understood in practice or should be further defined or described? And finally, do you think that implementation guidance or illustrative examples would be needed? With that, I'll turn it over to the committee for discussion.
Great. Thanks, Edward. Hillary?
Just real quick, and Edward, I thought you did a great job of walking through that. But, you take a look at those slides and the flow chart, it looks really complicated, right? But the key here being really trying to get to a point where certain of these variables today are causing these instruments to have to be liability classified and therefore have to be marked to market each period, right? And having maybe a different viewpoint of whether or not those variables should cause liability classification or should allow those to be accounted for in equity, which wouldn't have a remeasurement event, right? So when I really think about it, kind of stepping back from this, when we kind of get out of the flow charts and the specifics here, it's, really trying to get feedback with regards to the types of variables and inputs that you're seeing into these type of arrangements, and whether or not we've hit the right mark of, have we hit that split between what should be equity or what should be a liability appropriately? Because I think today more things end up in liability than I think the board was comfortable with, and we're just trying to make sure we get that line correct.
Thanks, Hillary. Any thoughts or questions, observations from members? Jared?
I would say from an investor perspective, our biggest concern would be reporters hiding liabilities within equities, and nothing about this seems to suggest that that would, this simplification would be a risk.
Thank you. Marcel?
I just have a question, and we don't really deal with this in our environment, but is this going to move the needle significantly, Hillary, to what you said? Like, is it big enough, these couple of changes, that it will take a lot of the things from liabilities and put it into equity? Was there more to do, maybe, to get there?
Yeah, and I think, and certainly interested of, viewpoints from the committee members here, but I do think this is going to move more things into equity, because there are a lot of these type of inputs into, the adjustments or the number of shares that will be settled. And I think over time, these adjustments have been put in, and there has been a very strict application of the fix for fix option pricing model, and whether it's an input for a fix for fix option pricing model, that has caused many of those to have to be accounted for as a liability. So I do think the changes we're making are going to put many more things into equity. I think this will take care of, at least the hope is this is going to take care of the vast majority of the situations where people feel like those should be equity, right? I think Edward kind of brought up a great point with regards to indexation to a commodity or things. Like, we don't think those things should end up in equity, but I think trying to get the right line of more of these things feel like they're tagged to the entity's operations, and trying not to be quite so precise and prescriptive of, if it's not in a fix for fix option pricing model input, trying to make it easier for people to apply the guidance as well, I would think.
Thanks, Hillary. Randy?
Just a clarifying question, and maybe I'll have a couple of comments. On example 2, if I'm looking at this right, the result would be the step 1 would fail if the warrant was exercisable after gold hit a certain, I think it was gold. Yeah, gold hit a certain level. So if the warrant became exercisable if gold hit X dollars, then it would fail step 1, right?
If that was the fact pattern, that it failed if gold's met a certain price, then yes. If the contingent exercise provision was related to gold, for example, this could only be exercisable after gold hit $50. Yes, that would fail step 1.
So if I had a gold mining company and I set the exercise contingency based on revenue rather than gold, it would pass step 1, even though revenue is essentially a result of the commodity index. Is that right?
That's right.
Okay, that's what I thought.
And that, by the way, is one of the differences between step 1 and step 2. Because if there was a settlement adjustment based on revenue in step 2 under current guidance, that would be precluded because it's not an input to an option pricing model.
Right.
Under the acceptable variables approach, that would align step 1 and step 2 in that way.
Yeah, I guess my comments are, I do think this will result in more things being in equity. I don't know that that is necessarily a bad answer, given the complexity of some capital structures now that have multiple classes of equity. This would just, in effect, be one more thing that people in valuation have to consider when they're valuing separate classes of equity. I do think that having examples is always good. I prefer examples that are if this, then that, and change fact pattern a little bit. You get a different answer, but that's just the way my mind works. But I do think having examples and implementation guidance is always preferable because it helps clarify the words somewhat.
Thanks, Randy. And I think walking through the examples today helped as well. So appreciate the team doing that. I have Christine, and then Shubu, and then Mary.
Yeah, I think it will result in more items being included in equity in response to your question earlier, discussion, Marcel. But we do also need to remember that there is another step, even if it's indexed. And that is that it has to go through the equity classification guidance, which will then, depending on the form of settlement, potentially kick it back into liabilities. And so the project is not focusing on the whole model. It's focusing on this one slice of the model. And so I think there's still the opportunity or the possibility for unintuitive outcomes because of form of settlement getting kicked back, or potentially putting pressure on how the contract is structured to ensure that the form of settlement does not do that. So I think it'll be interesting to see how all of this plays out.
Thanks, Christine. Shubu?
Yeah, hi, this is Shiva here. My only observation, since you mentioned convertible debt, just wanted to also make sure the exercise contingency allows for a situation where the convert is deep out of the money, in which case there is no possibility of the convert being exercised in terms of the strike price of the stock. Would that still be considered indexed or not? And maybe give some examples around that. A very deep out of the money convert versus a very deep in the money convert. Thanks.
Thanks, Shiva. We're not planning to change any of the convertible debt guidance other than how you think about indexation.
And I think just to be clear, we're not changing the probability. There isn't a probability assessment that comes into play when determining that. So I don't think there's any change with regards to that in reference to this proposed model.
And I know you mentioned exercise contingency. That would be step one. We're not changing anything under this project related to step one as well.
Thanks for that clarification. Mary?
I think it's important to recognize that the scope of this is very narrow. And I'm going to draw the analogy of like filling in a pothole. However, I think it's also important to understand that we have a liability equity issue that keeps coming up. And this is like day one accounting stuff. If you imagine teaching accounting, liabilities and equity comes up pretty early, in the class. And so this is fairly foundational, and it feels like the kind of thing we should be able to resolve so that it doesn't keep coming up. And so I just encourage us to take a step back. First, I applaud the board and the staff for identifying a pothole that can be patched with hopefully very little controversy. And so I understand the reasons for the narrow scope of that. However, I think it's also good for us to think about that this should be a problem that we can do this. Somehow we can do this. This is so foundational to accounting. And so I just encourage us to think about the broader problem and ways to address that as well.
Thanks, Mary. Any other comments or observations about the acceptable variables and the examples that we walk through? Okay, let's move to the next part.
Cool. Thanks, Alicia. So next, we're going to cover a couple other areas that the board's going to consider in an upcoming meeting. So we're going to talk about down round features first, and then we'll jump into transition. But after down round, we'll stop for questions, and then after transition, we'll stop for questions and feedback. So here we just have a brief overview of down round features, and these are features that reduce the strike price of an instrument if the issuer sells shares of its stock for an amount that is less than the current strike price of the instrument, or if the entity issues a new equity-linked instrument with a strike price below the current strike price. So under current GAAP, these features are explicitly scoped out of the guidance that's in section 815-4015. So they are not evaluated as part of the indexation analysis, but they are still evaluated under the equity classification guidance that's in section 815-4025. So this guidance was the result of feedback that was raised by PCC members and TIC, and those stakeholders noted that there was a significant reporting burden and income statement volatility associated with liability classification for instruments with down round features, as well as uneconomic outcomes in those cases. So as part of this project, the down round guidance could be affected because of changes that are made to the indexation guidance. So with that, we do have a couple discussion questions we want to talk with you all about. First, we'd just like to understand whether you all are aware of any challenges or encountering any challenges in applying the current down round guidance. Bless you. How would you expect down round features to be evaluated under the acceptable variables approach? And then last, whether the board should consider modifying or removing the down round guidance. So I'll now pass it over to you all for discussion.
Anyone want to start us off on this topic related to down rounds? I don't see any volunteers. Is this an area that you're seeing? An area? No? Okay.
Yes.
Jeff?
Yeah, I just have I guess, a clarifying question. I remember when this came out. So is the concern that the topic we just talked about would change the conclusions on scoping out the down round? Because I'm just trying to like bring back my context on this topic. I think that when we put the down round guidance in place, it used to be that when you contracted these and a banker wanted down rounded protection, it would like instantly cause liability accounting, right? Which has caused a lot of volatility in P&L and so forth. We instituted this guidance, which removed that volatility, and they were, able to be equity classified. So I just want to understand the question, which is, we think that what we just talked about, adding, the features on indexing to, entities' own stock, it would change these conclusions, or are we trying to retain this ability to keep it in equity? I just want to understand that a little bit better. So I thought it was a positive change. The point being that I thought it was a positive change to be able to scope out the down rounds. And if there's risk that we're changing that, I would want to understand that a bit better.
Yeah, so definitely agree. We're not trying to change the current outcome. We actually think that the acceptable variables approach would capture down round features potentially now because of adding the variable entity's own operations or activities. And we think a lot of those features would probably be captured under that. So we're considering potentially removing the down round guidance if that is the case, but would like to understand whether that might not be the case in certain instances.
Yeah, and I understand. It's a unintended consequence kind of question, right? Like if we were to remove the scope out, is there an unintended consequence that we wouldn't capture and then we'd be back to the old world? I understand. Okay.
Yeah, I think Jeffrey, maybe not unintended consequence, but more that there's a scope out for it currently. And that scope out was created because of the cost and complexity of marking these to fair value every period. And so that is why the 2017 ASU scoped them out. But now, based on our kind of preliminary analysis, and we'll be presenting it to the board in the coming weeks, is that we think that it would be captured in equity and it would be allowable. And so we question why there would continue to need to be that scope exception, since there wouldn't be a specific example that said this has to be liability. So it's really just simplifying the guidance as that this is not a kind of a separate consideration you have to think about, and it doesn't get separate treatment as a feature.
Thanks, Erica. Brad?
Oh, sorry. I raised my hand when we were talking about the down round, and just I do believe that the acceptable variable approach would scope this out for the most part and it not be needed as an exception any longer. The only other comment I really have is related to the question one there. And, the guidance on this is fairly narrowly defined from a modification, for example, like, does it apply to both modifications or only issuances? So that was a thought process on question one. Or the first question there.
Great. Thanks, Brad. And hearing that confirmation from you is helpful as well. I know that we talked about it around the table, but we appreciate you sharing that feedback as well. Randy?
Yeah, this might be an area where some implementation guidance on operations and activities might be helpful, because operations are fairly easy I think, for people to understand, but how broad is activities? Since companies can do virtually anything within the scope of activities. I think where you're going with the down round is clearly issuance of additional stock or additional instruments at a lower price would be an activity that would be within the scope. But are there things that the board thought should not be within the scope of the broad label of activities.
Thanks, Randy. I think this is really helpful input before the board takes this on, so I appreciate that. Any other final comments on down rounds before we move to the next issue? Okay. Transition?
Thanks. So the final topic that we want to talk about with you all is transition. So when we were thinking through potential transition methods for this project, we thought that the transition methods that were provided as part of Update 2020-06, which among other things modified and simplified the equity classification criteria that's in section 815-40-25. We thought that those could potentially be a good starting point for this project as well, because that update amended subtopic 815-40 and the natures and the features of the instruments that were affected or will be affected by this project are similar to those that were affected by Update 2020-06, although 2020-06 is a little broader. In that, the board provided entities with an option to apply a modified retrospective approach or a full retrospective approach to transition. And under the modified retrospective approach, entities applied the amended guidance to instruments that were outstanding as of the beginning of the fiscal year in which the amendments were adopted. And then under this full retrospective approach, the guidance was applied retrospectively to all instruments outstanding as the beginning of the first comparative period presented. But under both of these approaches, instruments that were settled or expired during prior reporting periods were unaffected by the guidance. So for that, we just want to get a sense of what transition methods would be operable for companies to apply when adopting a potential new standard on indexation. So we have a couple discussion questions on the next slide to ask you all. So first, do you think that similar transition guidance that was provided in Update 2020-06 would be appropriate and operable for this indexation project? Do you think another transition approach would be more appropriate or operable, such as a prospective approach to transition? If so, if you could describe and explain that, that would be helpful. And then whether there are any specific expedients that the board should consider related to transition. So, for example, whether in this case as well, transactions that were settled or expired during prior reporting periods should not be affected by these potential amendments. So I'll now hand it over to you all for discussion. Thank you.
Anyone want to start us off on transition? Randy, thank you.
I'd go with the same transition approach. I'll defer to the investors, but I don't personally see a lot of value going back to periods where everything is already settled. It would create a lot of cost and work to identify the inventory of all items in history that may have ever been issued and settled. So I'd probably go with the same transition approach.
Thanks, Randy. Any additional information from an investor perspective or from others about transition? Jared?
I would say in general, investors prefer full retrospective, but I agree with Randy that the cost probably wouldn't warrant for this situation.
Thank you. That's helpful. Anything else on transition? No? Okay. Great. Well, thank you to the team. Really appreciate it. Was there anything else that we didn't get to cover that you want to draw out any further? Okay, great. Well, thank you very much. Appreciate it. Great input for the upcoming board meeting as well as on the decisions that have been reached. And with that, we'll move to the next topic. So just give us a minute to change out the teams. Thank you. So for our next topic, topic 3, we actually have 2 projects that are involved in this one. So we've got cash equivalents, disclosure enhancement, and then classification of certain digital assets. So joining us from the team, I have Tiffany Wiskowski, Jacob Rodman, and Erica is staying at the table as well.
Morning, everyone. We can move to the next slide. Before we
turn to the two technical agenda projects related to crypto assets and stablecoins, I'll briefly summarize the feedback that the board has received over the last year. The board received feedback from the 2025 agenda consultation. We've received a few agenda requests, and we've received feedback from the Presidential Working Group on Digital Assets Markets. And the feedback that we received is all very similar in that stakeholders have asked the board to provide various guidance on different areas of crypto asset accounting and accounting related stablecoins. So we've received feedback that the derecognition of intangible asset guidance related to lending transactions could be enhanced. We've also received information that the classification of stablecoins as cash equivalents is challenging. We've received feedback that we should work on the accounting for liquid staking, tokenized real world assets, issuer accounting, and stakeholders asked the board to expand the scope of subtopic 35060, which is related to intangible crypto assets, to include wrapped tokens and receipt tokens. So as a result of that feedback received over the last year, the board has added two projects. The first relates to the classification of certain digital assets as cash equivalents, and the second relates to expanding the scope of the intangible crypto asset guidance and to include wrapped tokens and to clarify the crypto derecognition guidance. We expect the board to consider the other crypto asset feedback that I mentioned at future board meetings. Next slide. For the next few slides, I'm going to walk through the cash equivalents project, and later on in our discussion, Jacob will walk through the project related to the accounting for the transfers of crypto assets. The objective of the cash equivalents project is to clarify whether certain digital assets like stablecoins may satisfy the definition of cash equivalent, and the second is to provide transparency about the amounts that an entity holds of its significant the amounts of significant classes of cash equivalents. Next slide, please. So before I get into the project in more details, I'd like to define the stablecoins that we're going to be talking about today, because some stablecoins are backed by reserves and others are designed to maintain a stable value or to balance the supply and demand through creating and destroying the stablecoin tokens. So the type of stablecoins that we're talking about today are those that are backed by reserves. So currently the largest stablecoins by market cap are pegged to the US dollar and have reported collateral reserves that are equal to or exceed the number of stablecoins that are outstanding. So next slide, please. The cash equivalence classification is elective under GAAP. However, depending on the terms and conditions and the rights conveyed through certain stablecoin arrangements, some stakeholders said that there is a lack of authoritative and consistent guidance that has led to uncertainty on the stablecoin accounting classification. This is whether they should be accounted for as cash equivalents, intangible assets, financial assets, or derivatives. The board has decided at a recent board meeting that it will provide illustrative examples to clarify whether certain digital assets like stablecoins satisfy the definition of a cash equivalent. In making this decision, the board also considered other approaches such as revising the cash equivalence definition or defining a new master glossary term that would apply only to digital asset cash equivalents. But ultimately, the board decided that this examples-based approach would best avoid unintended consequences. So if we move to the next slide, we'll talk about the tentative board decisions that were made at the April board meeting. And at that meeting, the board did decide to issue an exposure draft. So in developing the forthcoming proposed illustrations, the board decided that the examples will illustrate the concepts that link to the cash equivalence definition, such as an on-demand redemption feature, stablecoins that have a contractual cash redemption right from the issuer, and the issuer maintaining a reserve balance that is at least 1-for-1 in highly liquid short-term investments that exceeds or equals the amount of stablecoins outstanding. The board also decided to clarify that an entity should consider compliance with relevant laws and regulations when establishing accounting policies concerning which assets meet the master glossary definition of a cash equivalent and are treated as a cash equivalent. So on the next slide, let's talk about the proposed disclosure requirement. I think it's easier if we visualize it. So the board decided that all entities, regardless of whether they hold stablecoins classified as cash equivalents, would be required to annually disclose the significant classes and related amounts of cash equivalents. And the reason for requiring this disclosure for all entities is that the board decided previously not to define a stablecoin when illustrating the examples. And also we think there might be unintended consequences if we try to define it, because it could accidentally pull in other things that are not stable coins. Next slide, please. So in terms of transition, so the transition for the illustrative example, the board decided that an entity should adopt the guidance on a modified prospective basis as of the beginning of the annual reporting period in the year of adoption. It also decided that entities that are adopting the proposed amendments that relate to the illustrations would not need to perform a preferability assessment. And then for the transition related to the disclosures, an entity would be required to adopt the amendments on a prospective basis. And the board decided that an entity would be allowed to early adopt the guidance. And then after the comment period closes and redeliberations is completed, the board will decide on the effective date. Next slide, please. So the board will be issuing an exposure draft, and we expect it'll be out sometime during the third quarter, and it will have a 90-day comment period. And then if we move to the next slide, we have 3 questions for members today. The first is what current or anticipated role do stablecoins play in your company or your clients? Second, do you have any questions on the recent tentative board decisions that I just covered? And finally, do you have any feedback on the decision usefulness or incremental costs related to the proposed disclosures on the significant classes and related amounts of cash equivalents?
Great. Thanks, Tiffany. Anyone want to start us off on this topic for the cash equivalence aspect? Jared?
I would say the increased disclosures would be welcomed by investors and be useful piece of information in our investment mosaic.
Great. Thank you. Marcel?
Just from a preparer standpoint, I mean, there would probably be a small initial cost of just collecting the information, but I don't think it would be overly cumbersome. And I think it could be some really interesting information to investors to actually see where company keep their cash and the risk associated with the approach that they take to guard their cash and where they put the money. So I think that would not be a bad disclosure to add, being the one who's going to prepare it. So wouldn't be.
Thanks, Marcel. Appreciate it. I'm going to have some investors. So I have Shubu, Niall, and Mark. Shubu?
Hey, this is Shubo here. So, first of all, I welcome this, and to your question on how investors currently use this. Certainly, a lot of hedge funds and mutual funds are investing in companies that have assets currently either in stable coins or are sort of producing their own stable coins. So, certainly a very, very topical topic, if you will, in that sense. But one thing I'd like to actually just quickly ask is on slide 25, the example that was given, stable coins 25 and 20. I know it's illustrative, but is that classifying out 2 separate categories of stable coins or 2 different stable coins and their actual values? Maybe a little bit of an explanation there would be helpful to start with.
Sure, Tiffany?
Yeah, thanks. So it's meant to be comparative. So it's the 25 and 20 is really just meant to be, the 25 would correspond to December 31, 26, and the 20 would correspond to December 31, 25.
Got it.
Great.
And then just as a follow-up on that, what I think, I'm not sure if this is part of the disclosures, but one thing that would be a little bit more helpful would be also, if you go drill down into the 25 and 20, those are, points in time, but what exactly are the stable coins that comprise the cash and cash equivalents of the company? And the reason for this would, be, we just have to look back a few years. May 2022, the largest crash in crypto history was a stable coin. It was Terra USD. Which got unpegged to the dollar. So it's while it looks great when your stablecoin is pegged to the dollar, if there are no like for like assets backing that peg, there is a possibility of that stablecoin unpegging to the dollar. So it would be helpful to also maybe perhaps understand or have further disclosures around exactly which stablecoins we're talking about. And that would give investors, I think, a second degree of analysis to look at. Thanks.
Thank you for raising that. I've got Christine, and then I'll go to Niall.
Yeah, I just wanted to follow up on your comment there about the names or the types of stablecoins within the classification of stablecoin. So we did have discussion about whether it would be necessary to provide that level of disaggregation. I think that because we're applying the existing definition of cash equivalents, which has a fairly high bar for liquidity, and in the case of stablecoins, a requirement for it to be backed by liquid assets, and to have redemption rights that would also allow an entity to get to their cash quickly. I think that our expectation would be that the types of stablecoins that would get into this category would not be at risk of unpegging. That can always happen, of course, but hopefully the classification would be narrow enough that they wouldn't be in there in the first place. That said, I would be interested in hearing more about, whether investors think that just disclosing the whole category of stablecoins is sufficient, or whether they would still want information about the types of stablecoins that are within that class.
Thank you, Christine. Niall?
My take on this is disclosure is very important here. I look at digital assets as a source of systemic risk in the future that could be broad-based and difficult to measure. So understanding that systemic risk and the impact and how many of the quote cash equivalent assets of a firm are represented in this asset class or asset classes, I think is important. Thank you.
Thank you. Mark?
Yeah, I feel the same way. And I just had a question. Is there any data on how many companies hold these assets right now? Or like how big of an issue this is today?
Tiffany?
Yeah, thanks, Mark. I would say it's not as prevalent in public companies from what we can tell based on 10Ks and 10Qs. It seems to be more pervasive in the private company space. So that's what we can tell. And the other thing is that when we have reached out to public companies that hold it, that we don't see it in their 10K, it's because it's immaterial to their overall balances.
Can I just have a quick follow-up? I mean, yeah, because that's my take. When I was reading the slideshow, I have no idea. I mean, I guess that's part of the issue. Is I look at this stuff all the time and I'm not even sure. So I think it is a important value add.
Thanks, Mark. Abhay?
Yeah, thank you. Thank you for providing the guidance. I know it's not very prevalent in the public companies. So I'm an investor that prefers simplicity. So obviously having stable coins or any kind of these assets, in my view, adds a lot of complexity. So if you look at the balance sheet, the cash and cash equivalents parts of the balance sheet for me has almost zero discount when I calculate the intrinsic value of the business. But having stable coins just adds a lot of complexity. So in that spirit, I do have few suggestions if those could be implemented. So number one are disclosures. So I think any company who's using any kind of stable coin or similar digital assets needs to answer this basic question: why? Why not plain good old US dollars in the bank account? Why a stable coin? Right? So understanding the why answers this question: what are the inherent motivations of the management team who is trying to collect these kind of assets? So I know a couple of examples in the public companies there's a misuse of using stable coins as cash equivalents. So that's number one. And then secondly, if you look at the current disclosures, when you look at the cash and cash equivalents, so there's a section which talks about the credit risk, meaning that like the cash that is sitting on the is on the bank, the companies have to disclose like the quality of the banks and whether in the instance if the company goes down, whether those cash is really a cash is like a dollar for dollar. What does that disclosure mean for a stable coin? Right? That's one. Secondly, in the case of companies that have offshore operations, so let's just say they have operations in the UK or in India or China, right? So if the stable coins is being held there, right? What is that implication for a investor who is invested in that company's stock traded in the New York Stock Exchange? Is it still one-on-one conversion? That's another complexity. Another one, is it something like a repatriation or something like that? I don't understand. Like in the case of like currently if a company holds cash outside the US, and there's some kind of tax implications if the cash has to be brought in within the US. So what does that mean for stablecoin? Another one would be, and I have no idea again on the FX side, the foreign exchange side, does it have any implication from that perspective as well? So basically pretty much I went through this list, but I think pretty much every guidance that is there on the cash and equivalent from a US dollar or a money market fund perspective, it has to be very clearly laid out, right? But again, I'll go back to my first point. I think the why. The why has to be very, very clearly written out, spelled out. Why are we doing this at first place, right? What's the use of this? What is the purpose of this, right? So thank you for hearing my rant here.
No, and I really appreciate the specificity about the additional questions that you have in this area. Bob?
Just further to Mark's point, I would be surprised for any private equity-backed company that they would hold stable coins as a cash equivalent. They may take them as compensation for whatever they do, right? But I would think they would liquidate them pretty fast. So just to say, I don't know how big given how much private equity invests around the country, right, around the globe, be surprised they really hold any massive quantities unless that was core to the operating company's thesis.
Thanks, Bob. Marcel?
No, I'm just thinking, it's like, I had the same question, why would you do that? Because we don't have any stable coins. But, getting back to Christine, my assumption would be that you talk about the reason why it's in cash and cash equivalents because it's highly liquid. It's backed by security. It's one-to-one. It can be turned into cash immediately. So I would expect as a preparer, should we ever hold that in your accounting policy would probably describe those facts, why you get to the cash and cash equivalent sort of requirements. And maybe that should be a requirement. Do you have stable coins to sort of spell it out and best practices? I think, what we would do if we would have that from the why question, if it's significant, that's probably more as a public filer would go into your liquidity section in your MD&A, where you talk about that. Because sometimes, financial statements doesn't really drive business decisions why you make certain things. And certainly shouldn't go there. It's more of information preparation and then give people and investors the opportunity to ask questions about why do you hold a certain kind of coin, and you as management making a decision how significant that is. And I think expanding that in financials, there's a lot of other things happening. So as a preparer, I would probably not advocate for putting that in financials, but expectation that companies would disclose if it's significant from that standpoint. But I think adding the example in there, calling out the different kind of liquidities is a step forward in the right direction in really helping investors understand companies' risk appetite, why they want to do something. And it does infer a lot of information just about the company and how they act.
Thanks, Marcel. I have Brad and then Mary. Brad?
Yeah, I was originally looking at this and saying, hey, it is a cash equivalent, right? So breaking it out and disclosing what the nature of it is would not potentially be all that useful. I'm hearing the investors talk. They clearly are considering it as something that has value. So breaking it out probably makes sense. But again, I would go back to what a cash equivalent is, which I think somebody said earlier. And if it meets that, it's fairly defined. So, it's able to convert to cash very quickly. So breaking out the detail, initially, I didn't think it would make a whole lot of sense, but maybe the question is, does it even make sense to be a cash equivalent? Because investors aren't treating it that way based on hearing how people are referring to it.
Thanks, Brad. Mary? Oh, go ahead, Mary.
So the category of cash equivalents conveys very high liquidity and essentially no risk. So the concern with adding items to that category is that financial statement users could underestimate the level of risk involved or of those items. I think I was glad to see that the board held a very high bar as to what could be allowed in cash equivalent, some of those qualities like redemption rights and reserves, reserve backed. And as this goes from a draft to final, I would feel strongly that that high bar needs to be maintained. So it feels like the bar is sufficiently high right now, and I would have concern over more items being included into cash equivalents beyond what's being discussed right now.
Thank you, Mary. Shubu?
Yeah, hi. Just to follow up on that, because a few people asked why do it in the first place. I think, first of all, this would be the most relevant for fintech companies who want to essentially issue their own stablecoin in terms of allowing for a medium of currency for their own customers to transact in. For example, of course, you're looking at Coinbase or companies in that fintech realm, like Circle Internet Group, etc. Second is to the point is that roughly about $300 billion of stablecoin in the U.S. today is going to get bigger, given the Genius Act has pretty much legitimized using it for treasury functions. And third is there are three major stablecoins today. So I guess it's not as relevant for them because everyone kind of knows the level of pegging done to them. The question is more about the ones that are to be introduced and how one should look at them and if companies should disclose which ones they are now using, apart from the big three, which are, of course, Circle's USDC, Tether's USDT, and PayPal's PayYUSD. These, there's no question about, they are kind of the gold standard and no pun intended on the gold standard, but more of they're a US dollar pegged standard. And that's very fair. The question is what happens beyond them to potentially other smaller stablecoins that are yet to be introduced now that you've got the administration's kind of go ahead and use stablecoins, and if you should disclose what those stablecoins are for the non-big three, if you will.
Thank you, Shubu. Christine?
Yeah, I just wanted to respond to the discussion that we were having earlier about pervasiveness and why is somebody using stablecoin. So based on the data that is out there, which could be kind of iffy to begin with, but it seems that currently the vast majority of stablecoin transactions are within the crypto markets. The amount of use of stablecoins in regular types of transactions where they're being used as cash to buy products and services is a very tiny, tiny fraction of 1% of US dollar transactions today. But that said, there is an expectation, I think, that stablecoins could really reduce the cost of cross-market transactions, for example. So across, US trying to pay something in, Italy or wherever. And so, we are kind of ahead of the market here in terms of providing guidance. But I think that I can't see very, Shuba, to your point, these are nascent developing markets. And I think that we might be well advised to overshoot early on in terms of the amount of disclosure that we require, because we really don't know what else is going to develop in this market. And we can always pull back on disclosures once the markets are more well developed and the asset class is better understood and the risks are better understood. But perhaps, the better part of valor right now would be to provide disclosures that we might not otherwise require for markets that are very well developed and understood.
Just a quick follow-up since you mentioned me, Christine. I'm actually agreeing with you, not the other way around. So I agree about the fact that these disclosures should be provided. In fact, I'm going a step forward and saying you should be providing even more disclosures on the type of stablecoin, not just that it is a stablecoin, but what is the kind of stablecoin we're talking about, so investors can assess the kind of value and the quality of that stablecoin you have in your cash reserves.
Yeah, I think you and I are in wild agreement.
Great. Randy?
Yeah, a couple things. I assume when the concept around the amount and composition of reserve assets and contractual redemption rights will be similar to money market funds today, that the definition of what the reserve assets would be. And I'll wait for the words on the paper, but I assume the reporting entity would have to have the ability to directly redeem with the issuer as opposed to going through someone else to do that, to classify it as cash and cash equivalent. Big assumptions on my part, but it seems to be the direction, at least the way I'm interpreting the words on the paper. My second thought was today assuming that is true, today there are hundreds of issuers of money market funds, and nobody is terribly concerned about the name of the actual underlying money market fund that people have within cash and cash equivalents. So assuming that the asset is, I'll say, similar to a money market fund, it would seem to be a lot of extra disclosure to name the names of the various funds. And I always think about this in the context of concentration of credits when you get into cash and cash equivalents, particularly cash equivalents. If you don't have a concentration as it's defined by the literature as a concentration, a disclosable concentration, then that's where I would draw the line on disclosures regarding any individual or in the aggregate stable coin.
Thanks, Randy. Fred?
Just a response, Randy. I think as we think about this, it's important to recognize the history of money market funds. And they haven't always been what they are today. And there was a period when they did break the buck and they weren't well understood. And I think that informs some of the other statements about the need for disclosures in this area.
Thanks, Fred. Stephen, did you have?
I think as an investor, it's also equally important to not just the cash and cash equivalent, but in the cash flow statement, because we focus on that a lot more. So how it lands and where it lands, that's important things, financial reporting to be considerate. So.
Thanks, Stephen. Any other comments about cash flow, cash and cash equivalent, or any of the other observations? This has been a great discussion. I really appreciate the feedback that's been provided around the table. Niall?
I really like the idea of a threshold, materiality threshold. As the new things develop, people try things, they have test elements. But if you're going full in, I think there should be large level of disclosure. And then so it allows the market to develop. But if you're really investing assets of a company in this space, it allows investors to understand what you're doing or the risks.
Yeah.
I think that the point about what is the discount factor you apply to stablecoin holdings is very material, because there is credit risk that exceeds US dollar risk.
Yeah, Niall, just to reiterate that point on materiality, materiality applies throughout the entire codification. So this would apply here as well. So I think in the example that we also illustrated, that if it's not considered significant during a period, you wouldn't get that disclosure you would get the disclosure of cash equivalents, but if, for example, say the money markets is not material for one period, you wouldn't get the amount for that, but you would for the other amounts. So I think materiality will continue to apply here. And I would expect that if a company is all in, using your words, on stable coins, you would see that amount every quarter, because all in my mind, says material.
Thanks, Tiffany. Mark?
Yeah, in this particular topic, what do you envision the definition of materiality to be?
I don't know that we've got a specific definition topic by topic generally throughout the codification. The FASB, broadly speaking, doesn't really get into the definition of materiality. What Tiffany's referring to there is a provision we have in topic 105 in the codification that says the provisions of the codification need not be applied to immaterial items. So we're leaving the determination up to the entity and its auditors about what is material, and just clarifying that the disclosures, other provisions do not need to be applied if the items are immaterial.
Thanks, Nellie. Mary?
I just have a quick question for Tiffany. Just now, when you were talking about disclosure, you mentioned quarterly, but is the current proposal that it be annual? I just wanted to make sure I was clear on that.
That's absolutely correct. Thank you, Mary, for correcting me on that. It's just annual.
Abhay?
Yeah, just a follow-up one. Will there be any kind of disclosure requirements regarding the cost versus benefit analysis of holding a crypto asset versus a cash equivalent? For example, if you have a cash equivalent, it's easy to value, it pays interests, right? And versus the benefit of crypto, as you mentioned, it reduces the cost, right? So, and then there's an extra time and money involved in disclosures for crypto asset versus a cash. So will there be some kind of a discussion regarding the cost benefit analysis?
Yeah, so when we, for every exposure draft and ASU that we issue, we do have a cost benefit analysis in there. So we'll definitely take into consideration what are the costs to do a disclosure of this nature versus not doing it, but then also saying, what are the benefits of disclosing it versus not. So that'll be in the exposure draft.
I think I hear what you asking about is a qualitative discussion of why the entity holds stablecoins, like the entity's assessment of the costs and benefits of holding stablecoins versus money market funds versus some other type of cash equivalent. That's what you are interested in, and that's consistent with what you were saying before about that you want to understand why they're holding it. We would call that like a qualitative disclosure about like the purpose of holding these assets or something like that. And the current decisions do not include that type of qualitative disclosure, but that's certainly something that the board can consider in the exposure period or redeliberations that maybe that if that's viewed to be useful, that that qualitative disclosure about why the entity holds this or what their thesis is for these assets versus other types of assets, that's something the board could consider going forward, but it's not currently part of the disclosure package.
Okay, sure. Because as I think Shubha was mentioning, it's more relevant for fintech companies, but for a manufacturing company, it might be totally irrelevant. So if those companies are holding a stable coin, why? Right. So, and then does it make sense for them? Yeah. Thank you.
Yeah. Thanks for that feedback.
Great. Well, really appreciate the discussion on this item. I think we'll go ahead and we'll move into the accounting for transfers of cryptos.
Yes, thank you, Alicia. So I will now discuss the next crypto-related project on the board's technical agenda, which addresses the accounting for transfers of crypto assets. On the next slide, I will start with a bit of background on the current crypto standard and what it does and does not cover, and that I think will be helpful context in understanding the projects on the agenda. As you'll recall, the board issued guidance on crypto assets a couple of years ago, which was codified into subtopic 350-60, and it was generally pretty well received. That standard addressed fair value measurement as well as financial statement presentation and disclosure aspects for certain crypto assets that meet the scope of that standard. Those issues that were included within that subtopic were the issues that were most pressing as identified by stakeholders at the time. Since then, and as part of the 2025 agenda consultation, as well as other recommendations received, stakeholders provided feedback that new crypto assets that are economically similar to the assets that are currently in the scope have grown in prevalence. However, these assets, such as wrapped and receipt crypto tokens, are not currently included in that guidance. Stakeholders noted that measuring those tokens differently from their underlying crypto assets may create operational complexity, inconsistent financial reporting, and may also provide an opportunity for resulting in artificial gains or losses that may not be decision useful for investors. These stakeholders also indicated that additional clarity to address derecognition accounting for crypto asset transfers is needed because there's currently no specific derecognition guidance for crypto assets. On the next slide, the project background. So to address both of those issues, the board added a project to its technical agenda in November and began initial deliberations relating to the expanding of the scope of subtopic 350-60 in April. The board will discuss derecognition guidance in a future board meeting. On the next slide relating to scope, so to provide additional relevant background, then this slide and the following slide just provide a little bit of guidance in the current crypto standard and then information on 3 types of common crypto transfer transactions that were raised. We'll go back to the former slide still though. On the scope, there are multiple scope criteria for an asset to meet to be within the current crypto asset guidance, including the criterion that is shown in the top middle blue box of the slide that requires that assets within the scope do not provide enforceable rights to or claims on underlying goods, services, or other assets. Stakeholders have noted that this is the criterion that often results in assets such as wrap tokens or receipt tokens that are, in their view, economically similar to assets in the scope being excluded because these assets convey a right to receive back the underlying crypto asset. We'll see that a little bit more on the next slide, which we can go to now. Related to both the scope and the derecognition objectives of this project, it may also be helpful to clarify and briefly describe some common crypto transfer arrangements that stakeholders requested to be clarified, as these also relate, as I mentioned, to the types of crypto assets that stakeholders believe should be accounted for within the scope of the crypto guidance. For example, in crypto lending transactions, entities may lend crypto assets like Bitcoin directly to a borrower to earn a return. Or they may place crypto assets into a lending or liquidity pool that is organized by blockchain technology like a smart contract, where there is no specific borrower identified. In crypto staking, entities may use their crypto assets, let's say, for example, Ether, to participate in activities on the Ethereum crypto blockchain network to earn rewards. Or they may delegate their assets to other entities to do these activities on their behalf. In crypto wrapping, entities exchange one crypto asset for another that may have enhanced functions and independent price. These wrap tokens provide the entity with the right to unwrap and receive the original crypto asset back. In these arrangements, new crypto tokens may be created that represent receipts or wrapped versions of the original crypto assets, but they are freely tradable. These tokens commonly evidence a right to take back the original crypto asset, which some stakeholders said creates issues in applying certain interpretations of control under Topic 606 relating to repurchase agreements and may prohibit derecognition in certain of those transfers. The next slide, we talk a little bit about stakeholder feedback. Because there's no specific derecognition model for crypto asset transfers, the relevant authoritative gap follows the general intangible asset guidance that leverages the concepts of control from the revenue accounting standard in Topic 606 relating to revenue. However, in practice, some entities apply a variety of guidance, including by analogy to certain non-authoritative sources as well, and stakeholders noted that this diversity in accounting for crypto transfer arrangements has led to inconsistent and sometimes counterintuitive accounting outcomes. As a result, in some stakeholders' views, financial statements may not consistently or accurately portray the economics of those crypto asset transactions. We'll talk about the tentative board decisions so far on this project on the next slide. In its April meeting, the board decided to expand the scope of subtopic 350-60 by revising that current scoping characteristic I mentioned that restricts assets from providing rights to other assets to permit assets that convey a right to assets that would otherwise be in the scope of this standard. In other words, crypto assets like wrapped or receipt tokens that give the holder a right to a crypto asset would now also be included in the expanded scope of the standard and would be measured in a similar manner at fair value, which in stakeholders' view better reflects their economics. This guidance also includes various disclosure requirements, including certain items such as name, cost, fair value, and number of units held for each significant crypto asset holding. And stakeholders noted that a potential benefit of expanding the scope of this crypto standard would be that additional crypto assets would be subject to this existing disclosure. And so the board decided to include an example disclosure within the proposed amendments to illustrate that wrapped tokens, if significant, would be disclosed separately from other significant crypto asset holdings. The next slide. This slide summarizes some initial direction on the derecognition aspects of the project. At a recent meeting, the board discussed alternatives to clarify how to evaluate whether control of crypto assets in the scope of subtopic 350-60 has been transferred, and to help clarify the derecognition guidance for these assets within topic 606. Because these existing accounting concepts of control are widely used and familiar. This includes evaluating whether some of the current interpretations in that model need any crypto-specific clarification, especially for transactions where the transfer includes a right to take the crypto asset back. On the next steps, the board will discuss these aspects of the projects relating to the crypto transfers and derecognition in a future meeting. With that, that brings us to some questions for the members here today. Whether you or your clients use or have experience with crypto assets, including specifically wrapped tokens or receipt tokens, what questions or feedback you have on the board's tentative decisions on expanding the scope of the current crypto guidance, and whether you have any questions or other feedback on the discussion or issues relating to derecognition of crypto assets in common crypto transfer arrangements and lending.
Thank you, Jacob. Appreciate it.
Yeah.
Any comments, observations, questions from committee members? Jared?
I'm pretty novice in this whole topic. Can you help me understand the custodial issues or custodial risk of a wrap token?
And specifically relating to the underlying asset that has been transferred when you receive the wrap back, or who's holding the wrapped once you obtain that wrapped item?
I guess more on who's holding it and
Okay.
the risk that you don't actually get those assets.
Yeah. So there are various ways that a wrapping can occur. There can be an actual entity that you're transferring your crypto asset to, or it can be just locked up on a blockchain technology. I think we haven't necessarily evaluated all of the custodial questions that might come up. I think the transfers that we're talking about are ones that are other than generally custodial arrangements, which are, often not viewed as one that might actually exchange control, but are just held on behalf of that party. So I think a custodial question could be one that might be otherwise not within the scope of the project.
Other questions or observations? I know that this committee, previously, I'll let Shubu go. Go ahead, Shubu.
Hi, thanks. So just, this is probably, I agree with you. It's probably not as relevant to, I would say, over 90% of companies, publicly listed companies. But just a case in point I want to raise, there's, for example, companies that trade in crypto or, are doing Bitcoin mining, for example, tend to have a fair amount of reserves in cryptocurrencies, as you know, and a lot of them are staked and wrapped and lent. And so for them, it's very relevant. So just as a case in point, one of the largest holders of Bitcoin, 53,000 Bitcoin held by Mara, which essentially translates to over $45 billion in Bitcoin, gives that level of disclosure. So they talk about off that 53,000 Bitcoin, about $8 billion or 9,000 Bitcoin is lent to counterparties. 6,000 Bitcoin was pledged as collateral against credit facilities, and essentially a third of that, 40 billion plus reserve is either lent or used as collateral. So I guess the question is, companies that are obviously in that scale would you expect them to have higher disclosure sort of standards and higher sort of disclosure details versus the 90% plus that don't kind of, deal in that sort of a space? Thanks.
Thank you for the question. I think the general framework of the disclosure requirements would be applicable to both types of entities, but kind of as we've described relating to the concepts of materiality, to the extent the exposures are more material, more information would be included within that disclosure. And the nature of the existing disclosure framework within subtopic 350-60 actually describes those requirements as relating in part to the significant crypto asset holdings. So that it's a determination quantitatively of which holdings are significant that then requires disclosure, whereas those that are not are either in aggregate, otherwise disclosed together.
Jack?
Yeah, just say if that's a public company, that business primarily is around some sort of crypto activity, whether staking, et cetera, all in, so to speak, that they would have a lot of disclosures outside the financial statements, and our boundaries are the financial statements, which would be talking about their business strategy, et cetera, the whys, and some of that. And I think that's important to think about when we're thinking about what it is the board is proposing to disclose. So I hope that's helpful.
Thanks, Jack. Any other comments or observations on crypto transfers? I realized that we had some conversations with PMAC or SBAC as 350-60 or as the crypto standard was developed, and that, as Shibu mentioned, it may not broadly resonate, but certainly open to any other feedback or observations before we move to the next topic. No, if not, thank you, crypto team. Really appreciate it. So with that, we'll go ahead, and we are right on time for our break. So for those that are here in person, restrooms are out these doors to the right-hand side. They're also in the lobby. For those on Zoom, if you just would put your, if you're not already on mute, put your thing on mute, and then also you could turn off your camera during our break, and we will resume at 11 o'clock promptly. Thank you. Great. Welcome back, everyone. Let's go ahead and get started. We've got a couple of very intriguing comments before our lunch starts. So first, we're going to touch on consolidation and the definition of common control. So I'll hand it over to Chris Bowden, Sam, and Ari. Chris?
Thanks, Alicia. As mentioned, I'm going to walk through the board's research project on consolidation for business entities, and then we'll transition to a brief update on the board's project on the definition of common control. For both topics, we have questions for PMAC members, and they occur throughout the slide, so it's not all saved for the end. So I'm going to move through the background as efficiently as possible so that we leave as much time as possible for feedback. We can go to the first slide, or slide after this one. Perfect. So starting with background, a project on consolidation for business entities was added to the research agenda in April of 2022. And originally, the objective of that project was to explore a single consolidation model. In January of this year, the board discussed the feedback received through the 2025 agenda consultation and provided input on the direction of future research. Rather than pursuing a single model at this stage, the board asked the staff to research potential simplifications to the existing consolidation guidance, focusing specifically on the VIE model and VIE disclosures. So our objectives are twofold. First, to explore improvements to the VIE guidance that could reduce complexity, and second, to explore whether the disclosure requirements for entities with interest in VIE should be eliminated, streamlined, or harmonized with the requirements that apply to voting interest entities. So moving to the next slide, before we get into the specific areas we're looking at, I want to provide just a really brief overview for context. Consolidated financial statements present the results and financial position of a parent and subsidiaries as if they were a single economic entity. So that means assets, liabilities, revenues, expenses, cash flows are combined, and intercompany balances and transactions are eliminated. Under current GAAP, business entities generally apply one of two consolidation models. The voting interest entity, or VOE model, triggers consolidation when an entity owns a majority voting interest. The variable interest, or VIE model, applies when an entity has a variable interest which could be a debt investment, equity interest, contractual rights, or other arrangements that provides both power to direct the activities that most significantly impact the VIE's economic performance and the right to receive benefits or the obligation to absorb losses that could be significant to the VIE. So with that as a background, we're going to move over to the next slide. So we've identified 4 potential areas for improvement that we'd like to discuss with PMAC today. First, the sufficiency of equity investment at risk. Second will be the related party guidance and the concept of what's sometimes called forced consolidation. Third will be transition, and fourth will be VIE disclosures. I'll walk through each one, and then I'm going to pause, as mentioned, to ask questions. So starting with determining whether an entity is a VIE. This slide illustrates the current framework for determining whether an entity is a VIE or is not, and therefore might apply the VOE model. When a reporting entity has a variable interest in a legal entity and no scope exceptions apply, it evaluates whether the entity has any one of these 3 characteristics, which is insufficient equity investment at risk, equity investors that as a group lack the characteristics of a controlling financial interest, or non-substantive voting rights, which sometimes gets called the anti-abuse provision. If any of those are present, the VIE model applies. If none are present, the VOE model generally applies. And with that as an overview, that brings us to the slide where we're going to talk about the first of those criteria, which is insufficient equity investment at risk. Under current guidance, and as mentioned, an entity is a VIE if its total equity investment at risk is not sufficient to permit it to, and I'm reading from the guidance, to finance its activities without additional subordinated financial support, which I know is a mouthful. An entity can be a VIE solely because of this criterion. So in terms of how this is analyzed, equity investment at risk of less than 10% of total assets is presumed to be insufficient. However, and this is an important nuance, equity investment at risk of greater than 10% is not presumed to be sufficient. As a result, some believe the 10% threshold isn't particularly relevant to the analysis. In practice, entities must demonstrate that equity is sufficient through a qualitative analysis, a quantitative analysis, or a combination of both, regardless of whether they're above or below this 10% threshold. So then, for historical context, this criterion was established in FIN 46 in the early 2000s. And when it was, the VIE model relied on a quantitative risks and rewards calculation to determine the primary beneficiary, which is the party that consolidates the VIE. However, the VIE model underwent a significant change in 2009 when FAS 167 was issued. FAS 167 replaced that risks and rewards calculation approach with the current power and benefits model. So the framework for who consolidates VIEs has changed a lot since this insufficient equity investment at risk criterion was initially introduced. However, this criterion itself has been carried forward without significant change. So the question is whether this criterion, which we've sometimes received feedback in, is challenging, whether it's still serving its intended purpose in the context of the current VIE model. And with that as a starting point, I'd like to switch to the next slide and turn it to PMAC members. Our first question is going to be, have you or your clients experienced challenges determining whether equity investment at risk is sufficient? For example, challenges in determining whether instruments are classified as equity under GAAP, which instruments qualify as being at risk, or whether the amount of equity at risk is sufficient per the previous slide. And then our second question will be whether the board should consider potential improvements, such as some of those that are listed in 2A and 2B. So with that, pause for discussion.
Great. Thanks, Chris. Does anyone want to start us off on this topic? Okay. How about on the first question in terms of the challenges determining whether equity investment at risk is sufficient? Does anyone have input either from a practitioner or preparer perspective about those challenges? Does this? No? Okay. Oh, Marcel?
Think about the concept, and I think it's important to think where this all came from way back in the day in the early 2000s and why there's VIE model was introduced and the disruption to the financial markets and all the damages. And it is one of the most complex areas in GAAP that probably more broader audiences deal with. That's not really unlimited. Most people at some point of time have to deal with it, all big companies, small companies, everyone. And simplification is always good. Bright line test is always, for me, personally, it felt like a point of easy manipulation. So I'm not always very much in favor of bright line, but on the other hand, the opposite also applies where people don't have bright lines. They manipulate it in a different way because it leaves a lot of judgment out there to determine. But I think, about the equity and the equity at risk, it's still a very valid question, depending on our investment and what's the exposure that you could have. It's always this could have sort of question that what do you have in there? What could you be on the hook for at the end of the day if things doesn't go out? That subordination of debt, or who's going to support the company or the entity? They don't have financing. That continues and is very qualitative, probably more than necessarily a quantitative analysis that would go into the inference of the qualitative factors eventually. But I can see this still being relevant. I don't know if there's specific challenges. I mean, there's always challenges in all application of GAAP, but I do think it's still relevant thinking of what happened with Enron and some other companies, and they've structured a lot of these investments in the past.
Do you have any reaction to the potential improvements in terms of eliminating that as a risk criterion or replacing it with, like you were describing, some of the qualitative aspects?
I would keep it, but focus more on the qualitative analysis of it than necessarily a bright line test.
Christine?
So are you in part saying that excuse me, if changes are made in this area, that we just need to be quite cautious about the potential for unintended consequences or game playing returning? Is that what you're saying?
I think, and first of all, there's always people that plays games, and I think we in this room, we have preparers, we have auditors, that sort of work, and we all keep each other accountable. But it doesn't always work I mean, as we all know, it doesn't always work. But in a perfect world, it does work. And I just don't like personally a bright line test, because then you think about lease accounting, have the same kind of bright line test. And how people manipulated what you put in your balance sheet and not in your balance sheet in the past, except of this concept of, is it really a liability for you that you finance? So sort of looking at that. So I'm not a big bright line test person, but people will manipulate it. That's just the nature of the human being. I mean, they will find ways to sort of justify not to include it in the accounting. And this is just very, very complex. But just stepping back high level, you go and look at where you have an interest and what's your exposure in that, and is it significant in context of the business. In principle, you should consolidate. Now, you have to put guidance on how people implement that and factor that into this particular concept of having a small investment, but having a potential obligation that far outweigh that you could have. And how do you look at that qualitatively? I think it's important. And then hopefully the system works, which is, I mean, a high bar that people keep each other accountable from an order standpoint, and preparers of high, ethical values and those kind of things that comes into play. But I don't think the 10% matters so much.
I have Bob and then Penny.
I mean, as a theoretical model, the bright line test, there's just so many things that go. I mean, that doesn't make much sense to me to have a bright line, because there's so many different variables that go into the assessment, right? So, 10% here of assets could be very different depending on the nature of the business or the underlying activities of the entity. Now, I also agree when it comes to a judge, this judgmental or qualitative test, right? That's going to be hard to provide guidance for, because that's in the end, it's management's judgment, and ultimately they'll have to convince their auditors of that, right? And so it'll become like the natural tension in any reserve assessment, whatever it may be in an audit. But it's just from a theory perspective, yeah, I think it's got to come back to the qualitative.
Thanks. Penny?
Yes, I agree with that. I mean, the 10% is difficult, and the insufficient equity is what drives the power and benefit, right? I mean, so the qualitative piece of it initially is what you have to look at. And if another entity is got the power and receiving the benefit, to me, that's what determines the VIE.
Thanks, Penny. Brad?
Yeah, I agree with most everything that's been said related to this is a qualitative approach for the most part. I think as you look at this, people evaluate this from a qualitative standpoint. If you're below 10%, I think people kind of don't say, hey, it's hard to get out of this, but just because you're over, I don't think people are automatically defaulting to saying it meets, and they're really doing it from a qualitative standpoint. I think some of the areas where you fall into difficulty, though, are like the startup type companies or early stage companies, investment research type companies. Those are the ones where they may not have a lot of equity, but does that automatically put them into this category?
Thanks, Brad. Randy?
Yeah, I think criteria B is actually the harder one to evaluate, whether the equity investors as a group lack characteristics of controlling financial interest. Having said that, and clearly based on all our discussion around debt and equity, determination of what is equity under GAAP is not always easy. It's a tough area of the literature to begin with, so I don't know that we're going to solve that problem in the consolidation guidance. The 10% test is almost we'll give you a bright line and then take it away. So it becomes sometimes difficult to determine whether you actually have sufficient equity just because it's over 10%, but is it enough? And in a startup company, what is enough? So that would be my thoughts on, can you eliminate it? You could probably simplify the words somewhat and around whether there's sufficient equity, but I think there are other criteria that make more sense to evaluate.
Great, this is helpful. So I think with that, we'll go to the next area. Oh, sorry, go ahead, Chris.
No, that was really helpful feedback. I just wanted to highlight a couple of areas that I think are interesting based on some of the feedback we got from PMAC members. One is for some of the startup entities, we had previously in the guidance had special version of this criterion for development stage entities. That was later when that concept was eliminated. So was the simpler version of applying this criterion for those. So I think that feedback is helpful and makes sense given some of the somewhat recent changes in the guidance. And the other item to highlight too, that I think is something we're thinking about, is part of determining whether equity is considered to be at risk means it has to, quote, participate significantly in profits and losses. So some conversations we've had focused around, is that alone sufficient? So I just wanted to highlight some of the items that we've been thinking about, but feedback today is really helpful on that. So then switching gears to related parties and what's sometimes termed forced consolidation. Related parties affect the consolidation guidance very differently under the VIE and VOE models. The VIE model specifically requires consideration of scenarios in which a related party group collectively has power and benefits, even though no single party has power and benefits on its own. In those scenarios, the related party tiebreaker test, which asks which party is most closely associated with the VIE, is used to require one of the parties to consolidate the investee. Importantly, in some of these scenarios, the related parties need not be under common control for the tiebreaker to apply. This can result in an entity being required to consolidate a VIE, even though it may not individually have power and benefits that would otherwise be necessary for consolidation. And again, that's what gets referred to as forced consolidation. And notably, none of these dynamics exist under the VOE model. This is very specific complication in the VIE model. So with that as a very high level background, wanted to flip to the question slide. And again, interested to hear feedback on what's being experienced in practice. Is this an area, given this forced consolidation requirement, where you or your clients have experienced challenges? And is this an area where the board should essentially consider improvements, including better alignment between the VIE and VOE models?
Observations and input about related parties? Go ahead, Marcel.
I mean, I haven't dealt with this a lot, but I think the first question on the 4A about the common control makes a lot more sense than when you have someone who doesn't have a common control and getting forced to consolidate an entity where they will not see the full benefits. And I know you have non-controlling interest and all those kind of things that flow out at the end of the day, but it sort of gets a really skewed outcome if you look at a P&L to the net income number before you allocate that. So I would be in favor of eliminating the consolidation where there's not common control, common control, but where there's common control, makes a lot of sense.
Thank you. Other observations? Randy?
This is probably as good a place as any to talk about this, because in this topic, we talk about entities not under common control. The next topic is what is common control. But yeah, I would have liked to have talked about equity method accounting and consolidation kind of as a single topic and think about it from the concept of the continuum of influence. And when do you consolidate? When do you have equity method of accounting on that continuum? I think all of these standards were issued at different times to address different problems that were identified at the time. So you end up with some differences in the way the power or control is defined between VOE, VIE. What is significant influence is different in equity method of accounting for regular corporation versus a LLC. And it just seems like thinking about it as in that continuum and figuring out, when do you really have control, and consolidate based on control, rather than some of the other factors that go into the various definitions, and recognize equity method of accounting when you actually have significant influence, because there are a lot of nuances in the way the literature is written. The equity method accounting focuses on voting interest, not economic interest, whereas the VIE literature, there is a concept of control, but it's also based on economic interest. So it just seems like there's some disconnect between the three, that I think there's obviously not in this project, because it seems to be fairly narrow focus, but it seems like there's a bigger project that might be available to create some consistency in that model of how much you influence the entity.
Thanks, Randy. Rich?
Yeah. Randy, to your point, do you think part of that's because we use consolidation as a blunt instrument to address when we didn't like accounting outcomes? So, for example, we didn't like operating leases, so we forced consolidation of SPEs, right? We didn't like the fact that guarantees weren't accounted for, so we forced consolidation of entities. Well, we've changed all that accounting guidance, but then we kept this blunt instrument of forget about the voting model, forget about all these other things. We're going to force consolidation. And so I always wonder, was our issue that we were using consolidation for lots of purposes other than it made sense to consolidate? And I think that gets illustrated. I won't jump to the next topic, but where we seem to not be comfortable with consolidation for some of these entities because we make you disclose all about the assets and liabilities of those entities so that effectively someone thinks about it as not really their entities. I don't know.
Yeah, that is the way I've thought about it, that a lot of these gaps have been filled through other things, because you end up with, if the only thing I have is my investment in the entity is a debt instrument, I don't have any other exposure to that entity. other than my recorded investment on my balance sheet, does it make sense if I never have to fund that? And if I do have to fund it, shouldn't that be captured in my guarantee liability rather than through consolidation or other means? But I think, like I said, it seemed like a lot of these were, the basic consolidation model goes back to probably the ARBs. So it seemed like they were written to address a specific problem at the time. And just at some point, does it make sense to step back and just look at it holistically and rethink the entire continuum? But I would agree with your comments.
Thanks, Randy. Craig?
Where I've experienced the most discussion and challenges along VIEs and related parties has been involving the roll-up or consolidation of professional service firms. And the examples, excuse me, the example would be, say, in sponsors that are rolling up dental practices. So the sponsor can't provide dental services, but they are in fact buying that dentist practice. They structure it as an administrative service agreement. They purchase all of the assets of the dentist, the chairs, the equipment, everything like that, but they do not purchase the dentist. So the dentist is there providing dental work and then outsourcing everything to the sponsor. Now, the dentist also has an equity investment in the sponsor. So you have that related party, but the sponsor wants to say, we have total billings that include the dental work, but really not. I think so I've gone through several of these, and it's just been more discussions with the sponsors of how we're going to treat this and how we're going to consolidate for the sponsor. The other example that comes to mind, again, in the professional service firms, and if you could think of these examples as you're working through issues like this, if we look internally to our own profession, and I was involved in 1996 when CBiz decided to get into the CPA business. And fortunately or unfortunately, one of my high school buddies was the first CPA firm acquired by CBiz, went through that, left that, started their own practice, ran that for 15 years. That practice was acquired by Markham. And then Markham was then acquired by CBiz. So he's gone full circle twice through CBiz. But again, CBiz does not, they're not a CPA firm, but they provide CPA services. And, that bright line is coming between VIEs and VOEs and who's benefiting what and really what power it is. And when you look back to, say, the dental practice, and you're looking at one dentist and you're saying, okay, what does that sponsor have over that? And how does that drive the business and what they're trying to do? And definitely when they're going through a liquidity event at the end of 5 years, they're looking at total billings and the whole thing in there, not just the revenue coming off the administrative service agreement. So it is a challenge. I've had the discussions with the auditors, with the owners, with the accounting staff there trying to do it. And it just depends on what the facts and circumstances are of where we end up at the end of the table. So I welcome the discussion. I welcome some guidance. It definitely is a qualitative type assessment, has nothing to do with 10% because the sponsor owns nothing of the actual operation, the dental surgery that's going on.
Thanks, Craig. Brad?
Yeah, I think from the tiebreaker rule, related party tiebreaker rule standpoint, I think my biggest concern would be the potential structuring opportunities that would exist if you remove this, to have entities that really have risk to the reporting entity that aren't being included in those financial statements. You take the tiebreaker rule out and you clearly have the ability for very smart individuals to figure out how to not consolidate something.
Thanks, Brad. Marcel?
Just getting, I mean, Rich said sort of the blunt instrument comment, and I think what Brad just said is that a lot of these rules were there to make sure that things aren't excluded. It's really giving the audience and the investor community the opportunity to evaluate the true holdings or risk associated with the business and where they play or decide to do business or not. And, you know, so you almost have to evaluate what's the most evil of the two worlds where you can be in, and what carries the bigger risk for investors in the capital markets. And this might not be a bad idea. You know, this is sort of how we solved it. One thing is just, I mean, and I still believe, and I would propose that the tiebreaker gets removed, but consideration, but it's a lot more complex, is maybe proportional consolidation, to really give effect on your P&L and your balance sheet of what your proportional risk is associated to that within an economic transaction that you participate in as a business. And I know that's a lot of complexities to that, but it exists. It's existed for a long time. And I think there's models that people apply it that can be looked to as an alternative.
Thank you. Bob?
To the question on challenges, what I would say in some cases, right, a lot of brain damage gets done to create these joint control situations by the lawyers, and then the parties, right, would represent the regulators and lenders and other participants, right, stakeholders, that it's joint control and they don't control, and yet we come back with some accounting answer that says you got to consolidate because you have control. So just again, it's another factor in the decision making here that people don't quite understand and wrap their mind around.
Thanks, Bob. Now I realize we're focused on a specific area, and we do have some discussion this afternoon on equity method as well. So we'll get into proportional consolidation and the equity method this afternoon a bit. But I wanted to turn it back to Chris and the team to go forward.
We're actually going to skip to Thank you. I think we're actually going to skip to the disclosure piece quickly, and at the risk of skipping over transition. So at a really high level, I think it's pretty well known that the VIE disclosures are a lot more extensive than those that are required for VOEs, which there are essentially no specific VOE specific disclosures the way there are for VIEs. These run the gamut from explaining why the entity might have been consolidated or how it might be supported. But just flipping to the next slide and the slide after, at the risk of keeping an eye on our time, just wanted to understand, we can go to the questions. Want to understand from investors, do we think the current VIE disclosures, if you've observed them in the past, are useful? And for preparers and practitioners, whether they are costly to prepare and whether they're still, and maybe for investors, whether you think they're still necessary.
Great. Thanks, Chris. So input, feedback on the VIE disclosures, current VIE disclosures. Anyone want to start us off? Go ahead, Jared.
To the question of whether the disclosures are helpful, I'd say yes. It'll be a later topic we talk about, but I do think firms hide behind the VIE, VOE, some firms, some bad actors hide behind it. So as much disclosure, especially on liabilities, is super helpful and probably could be more robust.
Thanks, Jared. Abhay?
Yeah, thank you. I have a few points here. So it might not be covered in few of the slides that you mentioned. So one of the things that I've seen in practice is that, like for me, what is more important is the economics of the VIE and how it impacts the cash flows, right? So what I have seen in practice is that some of the companies that are showing the income that goes to the non-controlling interests in the income statement and the actual cash that is paid, which is showed on the cash flow statements, the cash flow statement cashes that is going out of the business, like the real cash flow is much, much higher than the one that is shown up in the income statement. Like I understand that for a year or so those kind of discrepancies might get rectified, but I've seen those patterns like for the number of years, like 5, 6, 7 years. And I have not seen any kind of disclosure about the reasoning of that kind of discrepancy. And reaching out to the management teams is not helpful. And I've seen this more in the smaller company space, like let's just say under 2 or 3 billion in market cap versus in a bigger company space. So that's one. Another one is that I definitely appreciate all the disclosure, and there's a lot of disclosures. There's a lot of, which increases the complexity as well. But in a consolidated VIE, it does distort the economics from a return on capital perspective. So if you have a business, let's just say company A, having, let's just say, a 10% equity interest or whatever, 20%, and consolidating everything because of those two rules of power and having the ability to absorb all the losses, and then consolidate everything, but the leverage is non-recourse to the company A. But when you see the entire consolidated entity, the leverage ratios and the return on equities really get distorted. Like, for example, a company which is a capital light company, which has, let's just say, 20% equity interest in a high capital intensity business, their leverage ratio will really go up a lot, which is not the true economic picture for an investor like me. So I have to really do a lot of calculations to figure that out. So having that more clarity on the disclosure side, on the VI side, maybe just a simple balance sheet would be helpful, just from that perspective. And then I have one more comment for the unconsolidated VIEs, right? So I think for the unconsolidated VIEs, the risk could be much more greater than what is being depicted in the balance sheet. So obviously they're not forced to consolidate it, but for companies which are trust-based companies like banks, or let's just say car dealerships which are providing financing, right? So they have these structures of the customer takes up the loan, and then the loan gets attached to another structured finance company like trusts, and then the trust is being sold to the investors, right? So if those trusts go bad, right, so the companies say that we don't have any economic interest, so we are not going to get impacted, but it does impact their name recognition. So I'm not going to name any names here, but I have come across entities which have very good reputations, but their names get distorted. So risk could be much more higher in the case of unconsolidated VIEs as well. And then just the last point, because I gave a lot of thinking on this, was that there should be some kind of, like in the banks, we have stress tests. Like in the case of unconsolidated VIEs, there should be some kind of what's the maximum in this kind. I know there's a rule where you have to show what's the maximum loss, but does that rule tell you about, consider all the situations? We can just take the prior two historic examples of the 2008 financial crisis or the 2000 crisis and just tell in those kind of situations what could be the potential impact. So just the disclosure around that. Yeah. Thank you very much.
Thank you. Appreciate it. I have Stephen.
Yeah, and I feel like from an investor standpoint, it's sufficient, but I do have, there are certain exceptions, like for instance, consolidation, and then the companies would exclude certain assets or exclude certain liabilities, and it's hard for us to like fish that out. But just, I've seen some, companies that, exclude certain plants or certain countries within the consolidation, because obviously, there's some special provisions. I don't, so.
Thank you. Mary?
So I have 2 points, and one will refer back to transition. I know we skipped that, but so first, I do believe that the VIE disclosures are a pain point specifically for smaller companies. So I think it's good to be asking, is this helpful? However, where we find that the disclosures are helpful, I think we should be thinking about, should those same disclosures then be required for VOEs? Because the the situations are similar in terms of where the risks are. So as you learn about disclosure, that's what I would say is be thinking about the applicability of that for VOEs. And then secondly, back to transition that I know we skipped, prospective transition is definitely going to be much less costly, but I'm concerned about the interplay between transition and disclosure, because with prospective transition, as I understand it, we could have similar arrangements accounted for differently, and disclosure can help us through that. So where I'm concerned is if we go with prospective transition and then pull back on disclosure, that interplay is what concerns me. So just wanted to point that out.
Thanks, Mary. These are all helpful comments, and I would just say this isn't going to be our only bite at this apple as well, because I know this was a lot to digest. So we'll come back, and if we didn't touch on a specific area that you have input on, we can certainly circle back as well. Chris, I'm going to turn it back to you for common control.
I think given where we are on time, we might come back on common control. To your point, we'll have another bite at the apple, but
Okay.
appreciate everybody's feedback today.
Okay, terrific. So with that, we'll go ahead and move into hedge accounting, and really just thank the team for walking us through all of the different parts, as well as the input from committee members on all these areas. So for our final topic before lunch, we have hedge accounting. So joining us at the table, we have Aaron Cahill, Michael DeMarco, and Alex Cassis may join later. So I'll go ahead and turn it over to Aaron and Mike.
Thank you. Hello, everyone. So I wanted to start off by acknowledging that the details of hedge accounting can be nuanced, and that we appreciate that many entities either don't apply it because they don't manage with risk with derivatives, or they don't necessarily think that the benefits of applying it justify the costs. So given that, the goal of today's conversation is to discuss potential changes to hedge accounting broadly without necessarily getting into all of the nitty-gritty details of technically applying the guidance. But for context, we think it might be helpful to briefly discuss the history of hedge accounting. The guidance was issued in FAS 133 in 1998, when when the derivatives market was relatively nascent. Hedge accounting was a privilege, not a right, and it was designed to be applied to only a narrow set of facts and circumstances, rather than broadly reflect the economics of risk management. So that's to say, the fact that hedge accounting oftentimes does not convey the economics of risk management activities reflects its intended design. Hedging has consistently been on the board's agenda for the past 25 years in an effort to make it more operable. But since 2017, the board's goal in amending the guidance has been to facilitate financial reporting that more closely reflects an entity's risk management activities. But now the model in GAAP is somewhat at odds with itself because it was developed to be applied in relatively narrow facts and circumstances, but then has been subsequently amended to try to reflect more broadly risk management activities. So not surprisingly, in the 2025 agenda consultation, the board received consistent feedback that hedge accounting is in need of improvement because it's complex, it does not accurately reflect common risk management strategies, and that results in the use of non-GAAP metrics or entities just forgoing the use of derivatives altogether. And it also requires disclosures that are pretty voluminous, and we have heard from investors that they are not exceptionally decision useful. So at the February 25th, 2026 board meeting, the board decided to address the feedback in 3 stages, and each stage represents a separate project. In the short term, the board is focused on making targeted improvements that could be accomplished relatively expeditiously with few amendments to GAAP. In the medium term, the board decided to extend a certain type of fair value hedging called the portfolio layer method to liabilities. And in the long term, the board is exploring comprehensively reconsidering the hedge accounting model. And that the objective of that comprehensive reconsideration is to make it more accessible and to have it be more reflective of risk management activities across all types of entities. And each project is progressing concurrently. I'll focus the rest of the conversation today on the short and the long-term projects because I think those are most relevant to this group. The goal of the short-term project is to address 3 issues that were identified in the 2025 agenda consultation, and each issue relates to an exception or a limitation to the general hedge accounting model. And the project's aim would be to eliminate those exceptions, which would allow entities to broaden their application of hedge accounting. Issue 1 and 2 are probably the most relevant to this group. Issue 1 would allow HTM debt securities to be hedged for interest rate risk. That's probably most applicable to banks and insurance companies that typically have the largest HTM books. And that would free up more room on their balance sheets to designate accounting hedges, and we think that would lead to a more accurate reflection of risk management in their financial statements. And the second issue would remove the OIS parameter from SOFR when designating fair value hedges. So in practical terms, what that means is that it would probably allow corporates who would most frequently probably take advantage of this guidance, who have fixed rate debt, but who want to convert that exposure to a floating rate, to do so easily with a SOFR term derivative. We understand that corporates often prefer SOFR term derivatives over OIS because they know their cash payment at the beginning of the period, which helps with their treasury management, as opposed to if you have SOFR OIS, you might know a few days before the end of the reset period what your ultimate payment may be. And then with respect to next steps, the board plans on issuing exposure drafts sometime in Q3 with a 60-day comment period. And that will wrap us up on the short-term project. And then moving to the long-term research project, which is probably the juicier one. The board instructed the staff at the February 25th meeting to explore a new model and what that new model would look like. So the staff, we're still actively researching and building out a straw man of that model, but I can broadly describe the direction of travel. The objective of that new model would be to accurately reflect risk management activities in financial statements, and that would provide more transparency to investors. And by more closely aligning the accounting with the risk management function, the operability burden on preparers should be reduced. The goal would be to improve the accounting for all entities that use derivatives for risk management purposes, from the largest global banks to smaller companies that maybe have a few simple hedging strategies, maybe converting a floating rate loan to fixed or hedging out some FX risk from their foreign operations. The model would focus on accounting for derivatives and would aim to streamline the different accounting models that exist today. You might be familiar, there's fair value, there's cash flows, there's net investment hedging. This project would aim to have one hedge accounting model for all different types that exist today. And then finally, with respect to disclosures, we understand that there are a lot of hedging disclosures, and that investors have told us that they're not decision useful most of the time. And even for entities who do apply hedge accounting, they also often use either non-GAAP metrics or supplemental information to convey the economics of their risk management activities. So as part of this project, we would be looking to revamp the disclosures with an emphasis on the risk inherent in an entity's business model before derivatives are applied, and then the effect of those derivatives on their entity-wide risk position. Moving on to the questions. So we can maybe talk about the short-term project first. So that's the one on HTM and SOFR. If you have any feedback on those issues, we welcome anything that you would like to share in particular.
Great. Thanks, Erin. Any observations or questions about the short term before we get into the juicier area? No? Okay.
Yeah, that's not surprising. We have heard that this is pretty popular among banks in particular. I think they'd be looking to early adopt this pretty much as soon as we push the button and issue it. On the long-term project, we can just go ahead and ask all these questions to folks at once. We have two particularly for investors around what information would be most decision useful in disclosures about derivatives that are used for risk management activities. And then how would you want to see that information on the financial statements with respect to presentation? Would you want to see the effect of risk management derivatives as a separate line item, or would you want to see it maybe embedded in the line item that is being risk managed? And then for preparers and practitioners, are there any particular risk management strategies that you or your clients would like to see qualify for hedge accounting that don't necessarily qualify today, or it's pretty challenging to have them qualify? So.
Rich?
Yeah, and maybe for the investors, just bring it up a little bit of a level. A lot of times our disclosures are really good when there's an individual transaction, but when we get into the entities that Aaron's referring to, there is such a large volume of transactions that giving you a really big notional amount on derivatives, all it tells you possibly is that there's a lot of them. So what would you really want to understand? Is it the risk? What are they doing to manage their risk, and how are they exposed? What risk do they manage? Don't they manage? Or is it that quantitative type information that I think sometimes we question, what could you really do with it other than say, yes, it's a big number? So just maybe a reaction to that too.
Thanks, Rich. Anyone want to start us off either on the investment side or from a preparer practitioner's perspective? Go ahead, Stephen.
I think from the investor side, it's concentration risk. That's typically, an important aspect of it. I mean, just understanding derivatives and where they're concentrated in any particular magnitude. So,
Okay.
Yeah, thank you for the opportunity here. So, and thanks, Rich, for your comment. I understand the point that you're trying to say. The way I look about this hedging accounting, it's obviously complex, as we all agree here. It's like an insurance, right? So if you have home insurance, if a house burns down, we get paid, right? Similarly, a hedge that is not working is like an insurance. If a house gets burned down, the company also goes down. So we don't get paid, right? So I think, given all this complexity, I think one thing that will be very, very useful, specifically for banks, which do a lot of these activities, would be if there's a way to simply answer before we get into the actual details of the hedge, like to simply answer, did the hedge work during this time period or not? Let's just say for the past, if you're writing annual report, did it work or not? Yes or no, right? And then we can go on to the details of that. So that's going to be super helpful, right? And that will also kind of mitigate some of the bad activities that the banks or the other parties might do instead of using for risk management activities, using for trading activities. So that will kind of answer this question. Another point that would be helpful would be, I think the timing is already kind of is mentioned, but the reason for that timing should also be told, meaning that if a particular hedge was started at a particular date, but management decided that it is really a hedge from a later date, why? Right. So that would be helpful to try to understand better the intentions behind the management activities related to the use of derivatives. And then third point would be, it might be a long-term project, part of the long-term project as well, but I think a lot of the losses still are reported in the other comprehensive income, OCI. And I'm just completing the earnings season here, and I see a lot of banks have reported very large losses. And then in the footnotes, it's written that it's going to be recognized over X number of years. And I get that part, but I think very few people go to that part of the financial statements. So I think highlighting that if it is so large, maybe we can, just like in the prior discussion we had, like a threshold. Maybe if it constitutes more than 10 or 20% of your equity, if it is really going to hurt your equity, because banks are anyway very highly leveraged institutions. So if those losses are already going above a particular threshold, investors should be should know about it, rather than going in like a 200-page document trying to figure out that one line, or it was a, by the way, 4 billion OCI and your equity is just like 8 billion. So that's like 50% of your equity, right? So those are some of the points that come to my mind right now. Thank you.
Thank you. Fred?
Just as a follow-up question, when you said you want to know if it worked, current GAAP has what has been interpreted as a pretty bright line about whether it works or not with the effectiveness criteria. Do you find that kind of trigger approach to something working or not working more useful, or would you rather just see how much it worked if they hedged 50% just to know, hey, it covered 50% of it, or
Yeah,
kind of
so I think one example could be, let's just say, an airline who uses jet fuel, right? So typically jet fuel futures are very illiquid in nature, right? So what airlines do is that they might buy a crude oil future. So from an accounting perspective, it will satisfy the criteria. It's correlated, but it might, during oil shocks, which has happened in the past few years, it might not correlate. So they might go ahead and buy jet fuel of, let's just say, $500 million right now, just because the price has shot up, but it might not correlate with the crude oil price that they might be, but the actual cost might be much more higher than that, just because they have hedged with the crude oil futures. So there might be much more losses there, but versus what was reported. So I think just because there's a correlation in the past does not mean, in most of the cases, if there's illiquidity issues, it might work in the future, even if it satisfies the requirements of that, like the perfect hedge, or right?
Okay.
Yeah. But one more point actually comes to my mind around let me get back. Sorry for this. Yeah.
No problem. Hillary?
I think some of the questions that you're asking are good questions, because it really does kind of highlight the complexity associated with when we say, the disclosures related to hedging, right? Because we might be talking about that as hedging that meets our prescribed hedge accounting guidance, which is very prescriptive and, exactly to your point, may not exactly match up with the economics. People are doing certain things to try and get hedge accounting to work, but that's not what they would do if they were allowed to look at it a little bit more broadly. So you kind of have the things that apply hedge accounting. You have kind of the economic hedging that's entered into by entities, because either they don't want to go through the cost of having to apply the hedge accounting guidance, or they can't qualify on the way that the guidance is currently written today. And then you have speculative derivatives, right? So you have like this, menu of different reasons why people might have derivatives and use them, some of which are being used for risk management purposes, others could be for speculative purposes. I think part of the challenge we have with the hedge accounting guidance today is we are effectively making people create that difference between the hedge accounting world and the economic hedging world, right? Because we've been very prescriptive on, you can only hedge certain types of transactions on a transaction by transaction basis, rather than on broader portfolio bases. So I do think that a lot of things you're bringing up are things that we really do need to think about as we think about the broader hedge accounting project. As Aaron kind of mentioned, right, I think from an accounting perspective, it'd be great if we had an ability for folks to be able to apply hedge accounting in the way that they manage their risks, right? And have more of those things being reflected from a financial statement perspective. So we have less of that distinction that needs to be made between what type of derivatives am I using for risk management that I can get into the hedge accounting model today versus what are the ones I'm using for risk management purposes. And that could be both the economic hedges and the hedge accounting ones today. So appreciate the feedback.
Thanks, Hillary. And that's a good segue to our next question as well. I've got Brad here. But if there are any particular risk management strategies that you'd like to qualify that are not qualifying, certainly would love to hear that now. This is another topic that I'm sure we'll have another bite at the apple on the longer term area, but certainly if anything comes to mind. Brad, I'll go ahead and turn to you.
Yeah, the couple items that kind of go along that with what Hillary is hitting on, it's very prescriptive in how you got to meet hedge accounting, and items such as a net position hedging is how people manage their business economically. So considering those sorts of things long term. The other thing that's maybe a little bit longer term view look at this is similar to what IFRS 9 does on a rebalancing type process without terminating hedges and then having to reapply the guidance. From an administrative standpoint, there's difficulty in doing that, going through the process. So
Thanks, Brad. Any other observations, questions, comments on the longer term area? Mary?
I'll try not to knock everything over here. I just wanted to make a quick point that I thought it was really clever how you guys designed a short-term, medium-term, and long-term project, because by doing that, it allowed the short-term for us to really restrict our thoughts to just that. And if you didn't have a long-term project, then I inevitably would have said, oh, we need to be thinking also about a longer-term project. So I thought it was really clever the way you guys had that structured.
Thank you. Any other observations or comments from committee members, board members?
Just a quick answer to your second question, and I really appreciate you asked this specific question. I would actually prefer netting. So I think that will be very, very helpful. Yeah.
Thank you. Okay. With that, we'll go ahead and we'll pause the meeting for a lunch break. So we'll resume promptly here at 1 o'clock. Lunch is in the same area that we had breakfast this morning. And then for those of you that are online, if you could just turn your camera off, put it on mute, and then we will be back at 1 o'clock. Thank you. Great. Well, let's go ahead and get started and resume this afternoon session. We have some technical topics and otherwise. So we'd like to start off with equity method of accounting, the targeted improvements project. I know they had a board meeting yesterday. Joining us at the table, I have Ashley Tiskus, Edward Garcia is also back, and Jill Switter. So I'll turn it over to the team for an update.
Thanks, Alicia. So in response to feedback received on the 2025 Agenda Consultation Invitation to Comment, the board added a project to its agenda last November to improve the operability of the accounting for equity method investments. Additionally, at that meeting, the board decided the project would focus on two narrow scope issues. The first area, referred to as Issue A, focuses on the scope of the equity method, and more specifically, that investments in partnerships and similar entities are required to apply the equity method when an investor holds more than 3 to 5% of the investee, regardless of whether the investor can significantly influence the activities of the investee. This is different to the requirement for investments in corporations that focuses on significant influence and a 20% threshold. The second area of the project, referred to as Issue B, focuses on how equity method investors should determine their share of an investor's earnings when the investee has a complex allocation structure. So for example, in an investee that distributes profits and losses or cash using a distribution waterfall. Additional background information of each of these issues was included in the memo. Based on the project scope that the board decided to pursue, the staff developed paths forward for Issue A and Issue B, which are described in the memo. These paths forward formed the focus of the staff's research and outreach since the project was added to the agenda, which included outreach with preparers, practitioners, and users across different industries. At its meeting yesterday, the board discussed the project, including the feedback received, and made the following decisions. Related to Issue A, which is the scope of Topic 323, the board decided to require a single threshold, which significant influence, for applying the equity method to all types of investees. This was based on feedback that the different thresholds for evaluating the equity method result in inconsistent outcomes that are confusing, unintuitive, and difficult to explain to stakeholders. Additionally, to improve the operability of the indicators of significant influence in subtopic 323.10, the board decided to make 3 improvements. First, to change the 20% presumptive threshold in subtopic 323.10 to remove the presumption that an entity does not have significant influence when it holds less than 20% of an investee.
Under this improvement, when an investor holds less than 20% of an investee, the investor would evaluate whether it has significant influence based on facts and circumstances, and if it has significant influence, it would be required to apply the equity method. The second improvement to make the guidance more operable for partnerships, the board decided to amend the board of directors indicator to include functionally equivalent governing bodies, to acknowledge that similar governance structures may exist in other types of entities, such as an LLC with a board of managers. And third, the board decided to add a requirement that a non-controlling general partner or functional equivalent has significant influence. This is consistent with certain real estate guidance and acknowledges that by design, a partner that manages a partnership has significant influence over an investee. Lastly, related to issue A, the board decided not to explore requiring an entity to apply the in substance common stock guidance to investments in partnerships. So that guidance would continue to only apply to investments in corporations. Related to issue B, which was the complex allocation arrangements, the board decided to move the guidance in subtopic 973.23 that is not industry or transaction specific to real estate to subtopic 323.10. Outreach participants broadly supported this change and indicated that entities often analogize to that guidance when accounting for equity method investments in non-real estate entities, and therefore moving the guidance would not change practice, but would make the guidance clearer and more navigable. Related to issue B, the board also decided to add illustrative examples to topic 323 for how to allocate equity and earnings in complex allocation structures, because this would improve the operability of that guidance, and preparers could use that guidance in determining the accounting for these arrangements without having to analogize to non-authoritative literature. In making this decision, the board also decided that the examples should clearly indicate that the examples are a possible method that could be used rather than the only permissible method. In its meeting, the board also made decisions related to certain consequential amendments. First, the board decided not to change the population of investments that are currently eligible for proportionate consolidation, which is a method of accounting that can be used instead of the equity method for certain types of investments in the oil and gas and construction industry. Based on concerns from stakeholders about potential changes to investments in the oil and gas industry, where this method is widely used and supported, the board decided to make consequential amendments to ensure that those investments currently eligible for proportionate consolidation would remain eligible for that accounting method, including any associated requirements with that method, even if those investments would be in the scope of topic 321 under the amendments for issue A. The board also decided that the proposed amendments to address issue A should not affect the population of investments that are currently eligible for the proportional amortization method. Thirdly, the board decided to make consequential amendments to the guidance in topic 810 on allocating income to non-controlling interest holders to reference the guidance in topic 323 on complex allocation structures, because similar to topic 323, there is no guidance to address these arrangements in topic 810. And finally, the board decided to remove the guidance in paragraphs 970, 810, 25.1 through 25.3, which is specific real estate consolidation guidance, because like the guidance in 973.23, the guidance here is not industry specific and largely references to topic 810 anyway. In its meeting yesterday, the board also made decisions related to transition and early adoption. For issue A, the board decided that an entity would adopt the proposed amendments using a different approach based on whether an entity elects the measurement alternative in topic 321 or not, for those investments no longer in the scope of the equity method. So if an entity elects the measurement alternative, it would use a modified prospective approach, where the entity would use the carrying amount of its equity method investment on the date of adoption as the new cost basis under topic 321. If an entity does not elect the measurement alternative, it would use a modified retrospective approach. Then for issue B, which is the complex allocation arrangements, the board decided that entities should apply the amendments on a prospective basis. The board also decided to permit early adoption in interim and annual periods, provided that if an entity elects in an interim period, it would apply those amendments as of the beginning of the year. So finally, at its meeting yesterday, the board directed the staff to draft a proposed accounting standards update and decided that the comment period would be 75 days. And so I know that was a lot. Thank you for bearing with me. And we also had some specific questions in the memo, but given the decisions yesterday, we're happy to also take any questions or interested in any feedback you have on the decisions that the board made.
Thank you, Ashley. Appreciate it. Go ahead, Marcel.
Yeah, this is actually a topic that I'm very interested in because we deal with this across the board on a daily basis in all our investments. I think, first of all, I would very supportive of the change on the partnerships and the threshold to 3 to 5% because we get caught up in that a lot, and we've made some investments which was not for the purpose. We have zero control in private equity funds that got caught up in equity accounting just because of the threshold and how that was sort of set out in the guidance. And now with this proposal, I think we'll get a more sort of like aligned disclosure and accounting for those particular investments where we have zero impact on how we control anything in that business. It's like money that we just give, and then you hope you get a return out of it one day, like anyone else that invests in private equity. I think in the hypothetical book value method, it's also positive that's being brought in guidance, although it gets applied, and we've used the model for numerous years on one of our investments. There's some challenges in that, in particular, sort of like model and how it gets applied, and the accounting, it's more practical. I think when how the transactions sort of take place. One of the things that I always found really odd, if you think about a hypothetical book value method, is that it always depends where you sit in the stack and how your liquidation preferences get applied. And we've had multiple times, it's not planned that way. Where you make an investment, it's a very risky business that you invest in, and you get a liquidation preference, which 3x to the money you put in, and immediately on putting that money in, you book a gain of 3 times that or 2 times that through your P&L, and that goes through equity accounting. So that's just the way the model worked and sort of the allocation. But you look at the book value, which is the driver of the allocation as a proxy for the value of the firm, and then you start getting into like, okay, what's the true value? What's the fair value? Impairment? Do your allocation? So there's a lot of complexities that still remain in that model. Any guidance in that, would obviously be always valuable for preparers. Like we've put millions of dollars of gains in that, which you then eventually, because it's so risky, you just then flush again over time through a P&L the other way when you start booking losses in the entity. The other thing that's sort of also interesting, and depending on where you sit in the stack and your participation in different rights, as entities becomes more risky, you tend to have less people interested to invest at the top. And you get to a point in time where they start getting into your tier of investment and you book 100% of the losses of an entity through your P&L. And we often get the question from our audit committee and other folks, it's like, how do you think about consolidation in those instances? Now that you pick up all 100% of the equity, and what does investors sort of see when they look at that information? I think the model is probably the best, thinking about a complex multi-tiered investment, because it actually plays out the reality of the investment. It's just the disconnect between book value and fair value that does create a lot of, problems. Might be a company that if you do a valuation, fair value might be valuable way more than what the actual book value is of the entity. So there's some disconnections, even with the book value method that exists today. But, it's workable.
That's helpful. Really appreciate the feedback on each aspect of that. Any other thoughts, observations, or questions about the decisions, Randy?
Yeah, just real quick, and you may have said it. If I followed everything, the concept of significant influence will be applied to stock companies as well as other corporate forms. Within the definition of significant influence, were any of those factors reevaluated or changed as a result?
Yeah, so the improvements that I described that the board made to the indicators of significant influence, that was in response. We did outreach on, do those factors of significant influence also work for investments in partnerships?
Mm-hmm.
And some of those changes they're all were directly targeted at that. So for example, the one about the board of directors adding all functionally equivalent governing bodies is meant to capture different kinds of investments. But I will say one of the things that the board discussed at the table yesterday is because these changes are being made to all of the indicators of significant influence. One of the things we're going to look to understand is, are we changing how that guidance is applied to investments in corporate form entities that apply that guidance today?
And I think the one factor I don't think was in there currently that I might consider with respect to other legal form entities is design or redesign of the entity itself might be a factor to consider as having significant influence, regardless of some of the other factors. It would be, to me, that would be a factor I would think about demonstrating significant influence.
Thanks, Randy. Any other comments, observations, reactions? Okay, I know Ashley went through a lot, and I would just mention that the board's decisions have been posted on the website as well, and that, as Ashley mentioned, they're working toward exposure draft, so we will have another chance to discuss the changes and any other nuances that you think about with some additional time for reflection. But appreciate the update, and we'll be in touch. Thank you. Great. And for our next topic is actually a non-technical topic. So a good way to end the day before you go into your cookie sleeps. So this is our ongoing discussion about the effects of the use of technology on standard setting. And we've had discussions about this area in the past. So this is really intended as an ongoing discussion to seek your observations as this evolves about how technology should be considered by the FASB, including how technology could affect future standard setting, including the board's analysis of benefits and costs as it assesses changes to GAAP. So I thought what might be helpful to kick this session off, because we're really looking for some incremental input for the benefit of new members, but also for the benefit of members that were here 6 months ago. Just a quick refresher on some of the highlights that were covered at our November meeting to get the gears started, and then really looking for your incremental information on, is there anything missing, or is there anything new? So at the November PMAC meeting, some of the areas that we talked about that members shared with us were that primarily from a prepare perspective, that AI applications I primarily used for low risk functions, such as processing expense reports, conducting analytics, performing research, drafting memos, perhaps doing a first draft of disclosures, and that it's isolated to the events that generally pose fewer concerns related to controls, accuracy, and data security to core financial statement preparation. From an investor perspective, we heard from investor representatives that their use of LLM or large language models to efficiently search and synthesize information from filings, transcripts, while they also acknowledge that those tools may fail to capture broader context or may produce information of questionable accuracy. And you may have used different words there, but that's what we kind of had from the investor perspective. Furthermore, one of the other key takeaways was that technological advancements offer opportunities to automate areas such as the review of contractual terms, perhaps reducing the cost and complexity associated with implementing standards that depend on those contracts. Members also emphasized a widening disparity between organizations that have the capacity to invest in advanced technological tools and those with more limited resources. And we also addressed the workforce implications, including reduction of entry-level positions and an increased demand for judgment and problem-solving skills in an AI-enhanced environment. Additionally, from a standard setting perspective, some members suggested that we may need to consider the manner in which standards are drafted, given the evolving ways that AI tools interpret and apply authoritative texts. So that's just a brief recap on what we covered last time. The 3 areas that we'd like your input on, continued input on. We've got sort of separate question for investors, preparers, practitioners, and others, and all. So from an investor perspective, any input that you can provide on how technological advances are being used to digest, whether that's extract, process, analyze financial information, and also from a data reliability perspective, how you're managing different levels of verifiability, reliability. From a preparer and practitioner perspective, if you have any incremental feedback about observations about the controls, accuracy or anticipated costs and benefits of using those types of tools, I'd like to welcome those as well. And then certainly welcome feedback from anyone around the table about how should the board or FASB be thinking about technological advancements when evaluating the expected benefits or costs, or anything that you think the board should be aware of from a technology perspective. So with that, I will open it up for anyone that has some additional feedback. Marcel?
I'll go. So I think where we are today and where we're going to be 6 months from now is going to be very different in how people use technology. You talk about low risk areas. I can see us, especially in our company, in the next 6 months, we're moving to it being a lot more embedded in our processes, and even dealing with some more higher risk sort of analysis in our processes, which then question, and I talk specifically about generative AI, large language models, and all those kind of things. And that sort of exposes the control environment and the control aspect significantly, where there's a lot of discussions going on. What does that look like? How does it get audited? How do you get comfortable about the judgments and the human in the loop and all those kind of things, and how do you embed that in your processes? And then also, as these models evolve, that it might not give you the same answer a month from now than it gave you a month ago because of some new information being fed into the large language model and the limitations of that. And I think we're going to be very different, like in our organization, and the emphasis on that. And I would assume everyone else is in a very similar boat that we are of the investment. I think, think about one of the areas that people use a lot is accounting research, especially in the world. And I've been thinking about, because it's an inference model in the most, primarily, and you guys have some projects where you're looking at like the definition of a business and consistency across all your different sort of accounting guidance, where there's inconsistencies in standards and you have a certain intention of how it needs to get applied. The model's going to infer that in some way or form. You might get maybe a way it interprets it, where it infers some of the information if you don't have a consistent definition across the board in all your standards. So FASB, that's something to consider, is how do we drive consistency on every single definition that we have across the board and how it's intended to work. Because when it infers and it sees 5 different ways to look at something, it might, in one model that you're actually evaluating, look at some other guidance and apply that. The accounting guides of the firms that they issue are not always necessarily consistent in their thinking. And a lot of folks in practice, like us, even though you go to the FASB guidance, a lot of times their starting point is the accounting interpretation guides that the firms put out there. And often they have multiple ways that they suggest certain transactions should be dealt with, and different options and optionality, and every firm is different in how they apply that. And, it can have more disparity in that sort of practice. One of the things that sort of come up, apart from that, we are using it a lot more in exploring transactional accounting for our, and it's really as a people enhancer, or making sure we have limitations or getting more out of people and accountants and quality. And so is the cost that's associated with these models that you develop or these programs that you develop. And we're starting getting questions from a lot of our business units. Do you capitalize this, the cost involved? How is it going to look when these Anthropic or other companies start realizing, okay, that they can actually ask a lot more for these tokens, because we also embedded in these processes and reliant on these software that exist that we can't do without anymore. Almost like a drug addict that cannot get rid of it. And then, what's his name? The cost because everyone expects at some point in time the cost of tokens are going to increase significantly. And how do you deal with that from a capitalization standpoint, standard setting around that? When you do that, it's the expense as you go. Do you treat it like a human being that you would hire and pay a salary and you expense it, or is there some capitalization? And how do you set those thresholds of capitalization? And what does it look like? And that's not now, but it will come in time, where the cost is going to be significantly more. A lot of companies and a lot of other people are making adjustments to their workforce that's fairly significant because of the capability of these tools, and they're getting a lot better very quickly. So there's a lot of things happening. I think it's accelerating, and we come back in November, I'm sure a lot more folks around this table will have much more share from what they've seen or done or used and how that comes into play. And especially internal control framework also, it's critical in how that plays out.
Thank you. That's extremely helpful. Jared?
From a investor perspective, our industry has been facing a lot of pricing pressure due to the rise of passive. So there's a lot less eyes looking at financial statements. We're a lot thinner. In some ways, technology, brings us further away from the financial statements, but with the rise of LLMs, in some ways it brings us closer because now there are a pair of eyes that might, maybe we don't have the time to read through all the notes, but now there's something looking at those and we'll highlight them more. So the way I see it, in some ways it's driving us away from the financial statements, which is bad, but the LLMs help us to bridge some of that productivity issues that we have with less and less people looking at all these financial statements.
Thanks, Jared. Shibu?
Yeah, so I'm just going to give a few uncorrelated sort of musings about what's going on from my perspective. What we're seeing, I'd classify into two kind of categories. One is what the firms that we're invested in are doing, and what we're doing internally as a hedge fund or a asset manager. So in terms of companies that we're looking at, we invest in. Of course, it's across the board within tech, but what I've been noticing is companies specifically within the software space using AI. It's not if, it's happening today. So the day is now, and including companies that do accounting software. So accounting software companies today are all transitioning and pivoting into the use of agentic AI for accounting software use cases, and the usual suspects, and they're that's par for the course. That's number one. Number two, internally, I think in the accounting and CFO office, if you will, the office of the CFO, it's increasingly becoming adopted. So again, it's not a question of if, it's a question of when you get more AI usage. And the most obvious and natural case is for use in situations where, there's reference data. And reference data presents itself in accounting use cases extremely, extremely well. So it's about applying logic to an underlying LLM database, right? So that presents itself as actually the real poster child of where to use AI. So what I suspect is that's going to continue to grow a lot more, and you're going to continue to see the LLMs sort of. The other thing I'd like to mention is the cost of tokens actually, in my opinion, very humbly, I think is actually going to go down very, very dramatically. So it's kind of the other way around. And the reason is because usage-based pricing for software companies is going to be the de facto way they price these packaged software going forward, versus the SaaS companies which did it using a pay-as-you use on a monthly basis subscription model. So we are seeing a transition away from SaaS, software as a service, by subscription, by month, by year, to more of a as you use more, you get charged more. And as you use more, the price comes down, of course, because of just the package deals that you get are going to imply the adoption goes up. So as a result of all this, there's a lot of changes going on, not just in the pricing of software, but also in the usage of the agentic LLM models on the other end. So net, lots of change. We're in the middle of it right now, and things are going to look dramatically different, in my opinion, a year from now.
Thank you. Greg, from your perspective?
So what I'm seeing from within the office of the CFO is this push to become more efficient within that office. And what I'm typically seeing is that the company is hiring the consultant to come in. They are then doing the old-fashioned traditional flow charting. And when they get in that flow chart and they get to that classical diamond, which is a judgment call, yes or no, they're saying that that is a time waster because you got human people now thinking about something. And if you add up each of those, they're saying, well, we can carve out, 6 hours out of this whole process in the record to report cycle, which is really what we're talking about. So I think we really need to understand where we're taking that judgment out, especially with a lot of the discussion we already had today in terms of judgment calls, in terms of accounting treatment. I am seeing where they're trying to, in the learning models, get the models to, in fact, learn some of that judgment. But I don't know if that's sustainable or if it's right, or from the auditor's perspective, how they are going to be able to quantify that judgment when they come through the process. But they're definitely within the office of the CFO, and it's you go out onto the floor, you talk to your direct reports, you talk to your indirect reports, and you say, yeah, go ahead and dabble in that. See what you can do. It's okay. I understand you have these other priorities, but it is, like it's been said, in 6 months, it's going to be changing drastically. And I can see where there will be a push during the off-season accounting cycle of this summer, where a lot of that will be taking place and people will just be, go out and try it and see what happens. But definitely is out there, and it's definitely a push that's coming in that entire record to report process.
Thanks, Ray. Observations? Oh, Randy? Oh, no, I'm sorry. That's Stephen. I'm sorry.
So our organization, Graham, is really pushing into the AI area, and we've gone past the everyone try to figure out kind of thing, right? So it's gotten to the point, it's almost like I was at a data science company prior to Graham, and in the past, now a lot of the big asset management companies have a chief data science officer, and then to complement financial analysis as well. And now we're getting the organization has sort of someone who's a point person who trains the AI instead of you figure out what you're doing. And these would be simple tasks, like converting PDFs into Excel. And so there is already something written for the organization that each analyst or everyone can use. So it's becoming much more, I guess, standardized. And then it's incorporating data. And there's someone who's kind of accelerating those processes. And obviously, and this is the point, a couple of things I've noticed is when you run into exceptions, like let's say if, there's some financial statements that are different than the generic ones, then it kind of creates a lot of problems. Then it takes a lot of effort to kind of go through it. And that's something that I think I've noticed, some transactions internally. And then secondly, it's a lot of decision tree based, analysis as well. Like let's say if XYZ happens and let's go to this. So those are kind of the way I've noticed during this transition. So but going back, we have someone who kind of standardized dashboards, someone who, kind of you can work with the person to standardize that, or, have AI kind of help you do various tasks. So.
Thanks, Stephen. Dude?
I don't know. I'm an old dog, and in being an old dog, I think about a lot of things. 7 or 8 years ago, I was in a meeting, and this was really kind of before the AI as we know it, and some speaker was talking, and he said, "Does anyone know what AI is?" I said, raised my hand, I said, "Absolutely, it's artificial insemination." And so I think about, if we go back 10 years, none of us should be driving cars anymore. None of us. Because we were all going to have self-driving cars, it was over. We were never going to drive again. Hasn't happened. Sure, there are self-driving cars, some. I would love to see a self-driving car drive in Buffalo in a snowstorm in December. That would be fun. I think my controller who works for me he's smarter, faster, younger. He's 40 years younger than I am. Super guy. He's taken my job in a year and a half. Fabulous guy. It drives him crazy when he brings me stuff and I just look at him, that's not right. You're like, what do you mean it's not right? It just doesn't feel right. And you can't get from, if we don't hire new people and keep bringing in young people, then you don't have old dogs down the road. And I think it's always going to matter to have old dogs. It's the crystallized intelligence conversation. It's wisdom. And can that be replaced by AI? Some, maybe. I get up in the morning and I don't see AI building the roads that we build. We have people. And now they use great technology. It's fantastic. And we are making astonishing improvements, particularly in the world of safety, which is an interesting, not predictable, but there it is. I'm not very nervous about AI. I just think it's going to help the talented, bright people who have been able to use tools in the past to further themselves will do it again with a tool called AI. That's my take.
Thanks, Jude. Marcel?
Sort of adding a little bit to what Dude just said is that, and I have something else I actually wanted to mention, but now they said that is I think we're going to get into a point in time, 10, 15 years down the line, where people have made such significant investments in AI and generative AI and everything that comes out of that, that needs people to be able to interpret the information that gets produced. And we're going to lose a layer of people that doesn't come through the ranks of training and experience, and we won't have enough people to have the ability on a long-term sort of future to be able to interpret the results that we get out of that, because companies are making changes to their workforce, they're reducing their workforce, they're building out these models, less people work, less people looking at that, and people retire or they move on at some point in time. And that next generation that understands the basics, like the basics of accounting, like the simple, then it's T accounts, just how things flow and how it should flow, and economic transactions. And they cannot interpret what that means. And we're not going to have, so just as a caution, and I don't know how we overcome that, and hopefully people are thinking about that, is that we need to keep on developing the skill set and the knowledge and the ability of people to infer information going forward. And it's a big risk because everyone is so overhyped on cost savings and reductions and the use of AI to enhance people's ability to do their job. So that's just sort of a little bit into that. But I think there's a huge disparity in what a lot of these models can do. Some of them are definitely better at certain functions than other ones. And you see it when you run the same question through 4 different AI models that's out there. If you exactly the same fact pattern, some data, everything, they do very different jobs. And we've had some folks that's had significant success in even doing reconciliations, journal entry preparation. From the reconciliation, you've taken a data set, filtering through the data set, doing analysis on the data set, doing the reconciliation of the data set back to your books, and then actually proposing the journal entry. And then it comes to the human for review, basically. So these things are, and then when you start enhancing it and you're putting it into a project where these different sort of skills starts collaborating and talking to each other, they learn from each other. So, I mean, the advancement is significant. And this is just since November, not even the last 2-3 months that we've seen this, where people are doing that. And people are very innovative when they're under pressure and the things that they come up with. And these are not deterministic models. I mean, they are stochastic. They sort of like infer what's going on in information. It's always a risk, but they are getting much better. And I think that Office of the CFO is going to look very different. I think today there's a lot of research on accounting errors and how often accountants make errors daily, weekly, monthly. And it's shocking when you see it and then you sit there as someone that's worked in accounting, it's like, yeah, that sort of makes sense. People make a lot of errors in accounting, in booking entries and the quality of data. The technology is going to make a huge improvement in that, and giving people the ability to sift through all of those kind of possible errors and judgment errors and getting to a better answer probably quicker and higher quality financial information.
Thank you. Jason?
Yeah, just to kind of pile on what Marcel was saying, I think there's an underestimation of the pace of change and how fast this is going to go. And what I would like to do is identify the biggest risk. There's going to be a gap as we all reduce the number of university hires that we have to where we rely on AI and agents to do things. There will be a gap. It's going to be a huge gap. I mean, I'm aware of 3 Fortune 500 companies who are going fully agentic. They will have a CFO and no F&A staff, no FP&A, none of it. So like it's here and it's coming, and we're implementing stuff like Marcel said. It can do reconciliations. People are supervising non-human workforce agents, right? And that has HR implications. That's got SOX implications. I mean, there's all kinds of things to it. So I agree, 6 months from now, and certainly a year and a half from now, it'll be a very, very different landscape in my view.
Thanks, Jason. Greg?
I think there is a bright spot in the future. I understand that we're seeing risk and we are seeing that risk because we're kind of self-teaching ourselves how to use and implement AI. But if I think possibly what takes place 20 years from now, I do see this bright spot. So out of the 11 grandkids, 7 are in middle school. Those 7 are learning how to assess what they are driving out of AI and their research, and they're doing their English work or their math work and things like that. And they're in 4 different school systems, and I'm seeing it in each of those school systems where they're really working with those kids at that age of 10, 11, 12, 13 years old, of really how to challenge what they're pulling off of the internet. So I think there's a bright spot there, but I think we're going to definitely have this gap because we're just trying to do it so fast and not know what's going to happen.
Abe?
I'm going to add my 2 cents here. So first of all, I definitely agree with all the stuff that Alicia mentioned. So there's a huge boost to productivity. From an investor perspective, I would say, like for me, like 3 things, I think, like from 3 levels. So there's a correct data, there's a strong analysis on the data, and then there's I would say like an intelligent hypothesis. So that's how I make decisions on buying a stock or so. So AI has definitely been super helpful in speeding up the process of researching new industries, comparing against various industries, comparing the managements actually across various industries. Because if you have an auto manufacturer, how the different auto manufacturers choosing the various accounting standards, and I can get a sense of which management team is more aggressive or not. So it has been very helpful from that perspective. It has been increasingly helpful on the analysis side as well, but I haven't seen it very helpful from getting the good data side. But I'm sure that in the next 6 months or 1 year, we are going to get there. So the way the changes are happening. What I'm a little bit skeptical about is the hypothesis part. I still believe that, and I second what Marcel said, that we need to know the fundamentals. Like whether it comes to accounting, we need to know the T accounting, the double entry book system. And in the case of when you're investing, you need to have that pattern recognition, and you can't have that unless you have invested for a long period of time, right? Like a lot of people ask me that, is AI going to replace you? And I ask them another question: if you have $1 million saved up and you are 55 years of age, are you give $1 million to AI to go and invest on your behalf, and that's going to be your only saving, right? Are you going to do that? right? And you just have to answer yes or no. I mean, so I think AI is definitely going to be helpful in correcting the data. I'm pretty sure about it in the next 6 months to 1 year. Maybe it will start making models as well, right? And it'll increasingly become better on the analysis side, but I'm more skeptical on doing the correct hypothesis side, right? If I'm like, I run a consolidated portfolio, and if I'm putting a 10% position of my client's money and my own money, right, I have to have a super high conviction level to put that. And I'm not sure whether AI has reached that level. It might reach that level, but I think it's much more further down the road versus now. But yes, it has been very, very helpful in analyzing management teams. I can also look at track the audit costs from the proxy statements across various companies, like how is the audit cost changing, and compare that to the inflation, and to get a sense of which company is spending more on auditing or not. Or is it a high cost center if there's any kind of fat or not, and comparing if I get a new 10K, I can compare it to the previous 10K and see what are the risk factors that has changed, what are the accounting policies that has changed. So it has been very helpful. But the point is that AI can tell that. What to make out of it, you need to have that kind of basic fundamental knowledge and experience to get there. But yes, on a net basis, it has been positive, I would say. Thank you.
Thank you. Mary?
Yeah, I'll build on to that last comment you were making. So the second discussion question here is about evaluating expected benefits and expected costs of potential future changes in standard setting. And obviously anything I say here is just speculative, but because AI is able to process large quantities of information, I would imagine that the expected benefits of data that is disclosed increases. I have heard Rich made the point before of like annual reports with hundreds of pages and just the processing cost of consuming that information. And so I think AI will reduce those processing costs. And so I'm interpreting that then as increase in the expected benefit of disclosure. And then related to the expected cost of standard setting, I think about a recent standard that had significant implementation costs with the lease standard. And if companies were able to use AI as part of that implementation, would those implementation costs have been less? I'm speculating that it would have been. So as I am thinking about what this means for standard setting, is I would speculate that the benefits of disclosed information will increase and the costs of requirement of disclosure will decrease. That's my guess.
Helpful. Thank you. Marcel?
The answer is yes. We would have loved to have AI when we did the lease standard. It would have made a material difference in our implementation cost. But I think one of the things, and we talked about the knowledge base and making sure people continue to be able to interpret the information. And Greg, a little bit to what you're saying, yes, the kids are more comfortable with the processes. The people that's really successful in Gen AI usage in processes today are the people that really understand exactly how information flow gets evaluated and what those inflection points are where you need to have that evaluation and judgment. They're much better at building out the prompts, the skills, and everything else that goes with that, and they get a lot more success. So that process, yes, kids might be a lot more comfortable doing that and understanding the flow. But if you don't know what those decision points are that needs to happen and what it means, they're just not going to be successful in building models that's really helpful. And I don't think we can enough emphasize that continuation of knowledge and transfer of that.
Thank you. Niall?
It's interesting. One word I haven't heard today is due diligence. And we are all kind of fascinated with the outputs that these models have, but we're also becoming dependent on them because we're not asking direct questions and verifying. So I see that as a casualty unless you actively involve. And with the kids in particular, old dogs have experience in the sense that they can say, you know what, that doesn't sound right. But when a student has no subject matter expertise and uses these tools, you create a dependency. So I think one of the things that's really important is keeping a critical understanding of what you're doing and critical decision making. And AI aggregates lots of data, but it doesn't mean the data is correct. You know, an example that brought me to this committee was stock-based compensation and it being aggressively used, and it's added back to operating cash flow, but it's not an actual cash. So it's an overstatement of the cash. It feeds into the KPIs that are used for free cash flow and other things. And I would love to see disclosures that help people create linkages in the financial statements because there's so much data, but I think a lot of people don't understand the impact and people don't understand, you know, okay, cash left the door for this data center, but, you know, we're doing finance leases and, you know, what is the actual capital intensity of this business? So I think AI is interesting. I look at it as a tool. I agree with the analogy of the electric vehicle. We were all going to be driving them. They're part of what we do. I think it will help us make better decisions. But I also think that the scary thing is AI being used to hack each person's identity on this committee. And AI is not coming in the front door trying to take over your checking account and other things. It's using the forgotten IDs where you don't have second factor and back solving your passwords, and they're coming up from the bottom. So I think there's an incredible impact on security, cybersecurity.
Thank you. Greg?
So they are both experiments. We go through these tests. How do we make these judgment calls? How do we, you know, what's that decision tree going through? It would be very interesting. I don't know if it's any cost savings to anybody, but they definitely have the consultants in there and they're tweaking it every day, trying to get there so that they can get to the end of the line and report, you know, for June 30th.
Thanks for sharing that, Greg. This discussion has been very helpful, and it's amazing that only 6 months has passed, just given the new examples that are coming up, some of the new comments, new cautions. I think this is an area that will be on our continuing agenda, and just really appreciate you bringing all of the thoughts that you have to the table on this topic as well as others. We did have a reserve section for other business, so if there is any other business, certainly happy to take that. If not, happy to take emails and whatnot offline if there's an area that you want to see it come back at a future meeting, or questions that you have on any of the projects that we didn't cover today. Before ending the meeting, I just want to thank all of you around the table. We really value and appreciate your participation, your active participation and engagement in today's session, both continuing and new members. Really just a big thanks there. And also special thanks to Penny at our last meeting. I also just want to take a moment to express the appreciation for the project team staff that joined us here today. We would not be able to have the sessions that we did without them presenting and sharing the information and answering the questions that you all had, as well as listening to your views around the table. Just a moment also to thank Janice Jang, who is taking the next step in her career. She's leaving the FASB. We don't know exactly the employer yet, but we understand that you'll be moving on to LA, and we wish you all the best and really just appreciate all of the help that you provided over the last year. Also just want to thank and congratulate Christine Bodison as she completes her term at the end of June. I know that she's been a terrific member in our discussions over the years, and just want to wish you all the best as you move on to your next step, and to thank you for your participation as well. One other thank you, and I'm kind of getting long-winded here, but we had some recent changes with the administrative support, and so I just want to extend a special thank you to Tricia McKnight, who's supporting the operations of this group, along with Melissa Maroney, for all of the support in today's meeting, as well as travel logistics and the dinner that we all, or many of us, enjoyed last night as well. And so with that, we look forward to seeing you again this fall in November, and welcome you to continue to share any observations or questions that you have in the meantime. So our meeting in November is on Thursday, November 5th on 2026. We are also in the process of setting the 2027 meeting dates, and so we will send out a survey to pull you on some options for our May 2027, as well as a late fall meeting in 2027, so that we can get those on your calendars. So with that, thank you very much. Safe travels back, and look forward to seeing you in November.